Welcome to your exam prep review for the WGU Innovation in Finance exam. We'll study genuine test-style questions, say why one answer is correct, why the rest falls short, and the theory behind the difference. Our focus is Domain 1, the financial services landscape and fintech disruption, including a quick history of financial services, the three segments structuring the industry, what fintech means and why it's rising, incumbent banks versus fintech disruptors, the compete, buy, or partner decision. Head over to our website where you'll find free study guides and practice questions, all designed to help you conquer your D367 exam with confidence. Everything you need is right there waiting for you, and the link is in the description below. So take a moment, click through, check it out, and start studying smarter, not harder today. All right, let's get into it. Question 1. A rural cooperative operating in a region with no common currency tries to arrange trades directly between its members. One member has surplus grain and needs a plough, but the only plough maker in the cooperative wants cloth rather than grain, so the trade never happens. Which limitation of the barter system does this situation illustrate? Your options are A. A fractional reserve shortfall, B. A correspondent settlement failure, C. The double coincidence of wants, D. Net interest margin compression. Which one is it? Pause the video if you need more time. The correct answer is C. The double coincidence of wants. C is correct because the double coincidence of wants is the barter requirement that each party must want exactly what the other is offering, in roughly the right quantity at the same time. The grain holder and the plough maker fail that test, so the exchange stalls even though both parties want to trade. This friction is what pushed early societies toward commodity money and then toward institutions willing to store, measure, and lend it. A is wrong because a fractional reserve shortfall refers to a bank holding too little in reserve against depositor claims. No bank, deposit, or reserve exists in a direct goods for goods trade. B is wrong because correspondent settlement describes one bank acting on behalf of another in a market where the second bank has no presence. That is an interbank arrangement, not a limitation of direct exchange between two traders. D is wrong because net interest margin compression is a profitability pressure affecting commercial banks that earn a spread on lending. Barter generates no interest income and no interest expense to compress. Barter looks simple on paper. Trade goods directly, no money needed. But scale it up past a tiny village and it runs into a wall with a very precise name. Each party must want exactly what the other offers in roughly the right quantity at the same moment. Miss any one of these and the trade collapses even though both sides were willing. This isn't a shortage of goods or willingness, it's a matching failure. And matching failures get worse, not better, as more people and products enter the market, which is why barter economies stay small and local. Commodity money fixes this by splitting one impossible trade into two easy ones: grain, cattle, salt, and metal, each served as a shared unit of value. Once everyone accepted it, the farmer no longer needed a plough maker who happened to want grain. Watch for stalled trades between two willing parties whose goods just don't match. That's barter's signature problem. Don't confuse it with merchant banking's transport problem, which is about moving value that already exists, not creating it. Question 2. A historian searching for the earliest recorded deposit, taking and lending finds grain and silver held on deposit and loaned out under written rules that capped interest rates and set terms for what happened when a borrower's harvest failed. Which setting best matches this description? Your options are A. Temples and palaces of ancient Mesopotamia around 2000 BCE. B. Merchant banking houses of 15th century Florence. C. Goldsmith shops of 17th century London. D. The Bank of England shortly after its founding in 1694. Take a second. Which answer would you pick? The correct answer is A. Temples and palaces of ancient Mesopotamia around 2000 BCE. A is correct because Mesopotamian temples and palaces held grain and silver on deposit and lent it out under rules eventually codified in the Code of Hammurabi, including interest rate limits and provisions for failed harvests. That combination of deposits, lending, and codified terms is the earliest banking-like activity in the historical record. Nothing there resembled a modern bank, but the core functions already existed. B is wrong because Florentine merchant banks financed trade with bills of exchange roughly 3 millennia later. Their contribution was moving value between cities, not the first codified deposit and loan rules. C is wrong because London goldsmiths issued paper receipts against stored gold and developed fractional reserve lending in the 1600s. That is a far later development built on deposit taking that already existed. D is wrong because the Bank of England was founded in 1694 to help finance government war debt and became the template for modern central banking. It is thousands of years too recent to be the earliest recorded deposit and lending activity. Nearly 4,000 years before anything we'd recognize as a bank. Temples and palaces in Mesopotamia were already taking deposits of grain and silver, lending them out, charging interest, and enforcing written rules about default. Temples and palaces became the first bankers because they held three things almost nobody else did: physical security, a reason strangers could trust them, and a continuous existence that outlived any one person. A farmer wouldn't trust a neighbor with a season's grain, but a temple wasn't going anywhere. These practices were eventually codified in the Code of Hammurabi, which set limits on interest rates and addressed what happened when a borrower's harvest failed. Consumer protection in lending is not a modern invention. It's one of the oldest regulatory instincts on record. Mechanically, it was simple. A depositor brought grain or silver for safekeeping. The temple recorded and held it, and lent a portion to borrowers who needed resources before harvest. Interest compensated the lender for risk and for giving up use of those goods in the meantime. Banking functions appear wherever surplus, uneven timing, and trustworthy institutions coincide, which is why Greece, Rome, and Renaissance Italy each produced their own bankers independently. But when a question asks what came first, the answer is Mesopotamia. Later innovations like goldsmith receipts or merchant bank transfers are about what changed, not what began. Question 3. An ancient Roman merchant places funds with a private banker, later draws credit against those funds, and arranges a transfer to an account the banker maintains at a different location. Which group of early bankers is being described? Your options are A. The trapezitai of ancient Greece, B. The Medici of Florence, C. The goldsmith bankers of London, D. The argentarii of ancient Rome. Before I reveal it, which one do you think is right? The correct answer is D. The argentarii of ancient Rome. D is correct because the argentarii were private bankers of ancient Rome who took deposits, extended credit, and facilitated transfers between accounts at different branches. All three activities in the scenario map directly onto that description. They represent the Roman link in the chain that runs from temple lending to modern banking. A is wrong because the trapezitai were Greek money changers and lenders who worked from a trapeza, meaning a table in the marketplace. They are the Greek predecessor rather than the Roman one described here. B is wrong because the Medici were 15th century Florentine merchant bankers whose signature tool was the bill of exchange used along trade routes. They operated roughly 14 centuries after Rome. C is wrong because London goldsmiths stored gold and issued circulating paper receipts in the 1600s. That is a different era and a different mechanism from Roman deposit and transfer banking. Long before banks had branches, they had tables. In the Athenian marketplace, that table was called a trapeza, and the men who worked behind it were the trapezitai. A specialist sat behind that table, weighing coins from a dozen city-states, quoting exchange rates, holding deposits, and lending to ship owners before a voyage. That basic arrangement, one person behind a counter handling other people's money, has survived essentially unchanged into every modern bank branch. Rome's argentarii did everything the trapezitai did, but added something new, moving value between accounts in different locations just by adjusting records. That single insight, that money could move as information rather than metal, is the seed of everything from the bill of exchange to a modern mobile transfer. It's tempting to call ancient banking primitive, but the economic logic was identical to today's. A trapezite quoting a coin rate was making a market, and an argentarius judging a merchant's creditworthiness was doing credit analysis, all driven by the sheer trade volume and currency chaos of the Mediterranean. Don't confuse this with correspondent banking, which came much later and connects two separate institutions. An argentarius moving funds between his own branches was working entirely inside one system, and spotting that distinction is exactly what these questions test. Question 4. Early societies gradually shifted from trading goods directly for other goods toward using grain, cattle, salt, and metal as a shared unit of value. Which problem was this shift primarily solving? Your options are: A. Banks were holding too little cash against depositor claims. B. Direct exchange required each party to want exactly what the other was offering. C. Governments needed a reliable way to finance war debt. D. Merchants could not safely transport gold along trade routes. What's your answer? Commit to one before I continue. The correct answer is B. Direct exchange required each party to want exactly what the other was offering. B is correct because a shared unit of value removes the requirement that both parties simultaneously want each other's goods, which is the central bottleneck of barter. Once value could be stored in a widely accepted commodity, a farmer could sell grain to anyone and buy a plow from anyone else. That is the direct fix for the friction that made barter unworkable at scale. A is wrong because reserve adequacy is a question about institutions that hold deposits, and those did not yet exist in the form implied. Commodity money predates fractional reserve practice by thousands of years. C is wrong because financing government war debt is what prompted the founding of the Bank of England in 1694. It has no bearing on why early societies adopted commodity money. D is wrong because the danger of physically moving metal along trade routes is what merchant banks later solved with the bill of exchange. Commodity money made exchange easier but did nothing about transport risk. Money is often assumed to have solved the problem of hauling wealth around. It didn't. Commodity money solved a completely different problem first, one called matching, and that order changes how we should understand the entire history of finance. A good becomes money by scoring well on a short list of properties. It must be durable, divisible, portable, recognizable, and scarce. Metals eventually won not because gold simply looked appealing, but because they satisfied every one of these dimensions at once. Once everything is priced in one shared unit, comparison becomes possible. Comparison enables calculation, and calculation enables planning, which in turn enables credit, because a lender needs some way to state what is owed and confirm it's been repaid. A debt measured in one cow is a weak contract since no two cows are alike. A debt measured in a set weight of silver is precise, enforceable, and transferable. That precision is what let Mesopotamian institutions write meaningful loan terms in the first place. Money made finance possible. Commodity money wasn't a technical invention. It was a coordination achievement. requiring a whole community to trust that others would accept it. That same reliance on shared belief runs through paper, receipts, central banks, and every bank that stands solvent today. Question 5. A student claims that technology only began reshaping banking in the last 2 decades, citing mobile banking apps as the first real example. Which evidence most directly corrects that claim? Your options are A. The telegraph, SWIFT, and the ATM each collapsed distance or removed humans from banking long before mobile apps existed. B. Banking has remained essentially unchanged since the founding of the Bank of England. C. Regulation rather than technology has been the only meaningful force reshaping banking. D. Mobile banking was the first technology to reduce the cost of delivering financial services. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. The telegraph, SWIFT, and the ATM each collapsed distance or removed humans from banking long before mobile apps existed. A is correct because the telegraph allowed banks to settle between distant cities in minutes starting in the 1840s. SWIFT standardized secure global interbank messaging from 1973. And ATMs pulled the human teller out of routine transactions through the 1970s and 1980s. Each wave redrew what banking could do and how far it could reach. Fintech continues a long pattern of technology-driven change rather than starting one. B is wrong because banking changed enormously over that span, moving from local branch operation to national and then genuinely global scale. The claim of no change contradicts the documented record. C is wrong because regulation has repeatedly reshaped the industry, and it often interacts with technology rather than replacing it as an explanation. Naming regulation as the sole force ignores the telegraph, SWIFT, and the internet. D is wrong because cost reduction from technology long predates mobile banking, since mainframes and ATMs both cut the cost of routine transactions. Mobile extended a trend that was already decades old. Banking has been transformed by technology many times before, not just now. To understand today's fintech wave, we need to see it as one chapter in a much longer story. The telegraph turned distance from an absolute barrier into a manageable cost. Bretton Woods built the monetary architecture that later gave way to floating exchange rates and currency trading. SWIFT then gave banks a shared language to move money safely across borders. Finally, the internet and mobile devices did to everyday banking what SWIFT had done to interbank messaging. SWIFT itself is unglamorous by design. It is simply a standardized, secure format for one bank to instruct another to move money. That standardization is exactly what let cross-border payment volume grow without a matching explosion in errors and disputes. The strongest explanation for every wave, including the current one, points to the same 4 forces: falling technology cost, greater available data, crisis-driven reform, and available capital. These forces explain the telegraph era and the SWIFT era just as well as they explain fintech today. SWIFT is a messaging standard and Bretton Woods is a monetary architecture, not a technology at all. What actually matters is that each development lowered a cost or removed a constraint, and that is what lets new entrants attempt what only large institutions could do before. Question 6. A Florentine merchant in the 1400s must pay a supplier in a distant city but does not want to carry gold along unsafe roads. He deposits funds with a banking house at home, and the supplier collects the equivalent amount from a partner banking house at the destination. Which innovation is being used? Your options are A. Fractional reserve banking, B. Double entry bookkeeping, C. The bill of exchange, D. Federal deposit insurance. Which would you go with? Lock it in before the reveal. The correct answer is C. The bill of exchange. C is correct because a bill of exchange is a written order to pay a specified sum, redeemable at a partner banking house in another city. It allowed merchant banks to move value without moving physical metal, which is exactly the problem the merchant faces. This instrument was the signature contribution of Italian merchant banking. A is wrong because fractional reserve banking concerns how much of its deposits a bank lends out versus holds in reserve. Nothing in the scenario depends on the banking house's reserve level. B is wrong because double entry bookkeeping records each transaction as a matched debit and credit so that books can be audited. It is an accounting method rather than a payment instrument. D is wrong because federal deposit insurance protects depositors when a bank fails and arrived with the FDEC in 1933. It is irrelevant to a 15th century cross-city payment. A Florentine merchant needs to pay a wool supplier hundreds of miles away without risking silver on dangerous roads. The solution: deposit funds locally, receive a written order to pay, and let the supplier collect from a partner house in his own city. Value crosses the distance. Metal never moves. This is merchant banking, the practice of providing capital, credit, and payment services to merchants engaged in trade, rather than to ordinary depositors. The Medici of Florence are its most famous practitioners, but the model spread to every major trading center in Europe and the Mediterranean. The mechanism depends on trust. The two banking houses keep running balances with each other, netting many payments and settling the remainder periodically in bulk. That netting principle, rather than moving metal for every transaction, is what makes the whole system work, and it still governs how modern payment systems clear. Merchant banks also produce double-entry bookkeeping, recording every transaction as a matched debit and credit to make fraud and error detectable, and correspondent banking, where one institution holds deposits and acts for another in a distant place. Both remain central to global finance today. A business built to finance trade gradually became a business managing the wealth of the merchants it served, and their families after them. That is the historical root of modern wealth management, from financing a shipment of wool to algorithm-driven portfolio management today. Question 7. A mid-sized bank has no offices in a foreign market but needs to settle payments there for its clients. It arranges for a bank already operating in that market to hold deposits on its behalf and act for it locally. Which arrangement does this describe? Your options are A. Underwriting, B. Correspondent banking, C. Unbundling, D. Fractional reserve banking. Don't overthink it. Which one feels right? The correct answer is B. Correspondent banking. B is correct because correspondent banking is precisely this arrangement, in which one bank holds deposits for another and acts on its behalf where the second bank has no presence. Italian merchant banks developed the practice, and it remains central to how global payments clear today. The absence of local presence is the identifying detail. A is wrong because underwriting is an investment bank, pricing, purchasing, and reselling a new issue of securities. No securities are being issued or placed in this scenario. C is wrong because unbundling is a competitive strategy in which a new entrant captures one profitable piece of a bundled relationship. The scenario describes cooperation between two banks, not competitive capture. D is wrong because fractional reserve banking describes the proportion of deposits a bank lends out. It says nothing about how a bank operates in a market where it has no branches. Correspondent banking is an arrangement where one bank holds deposits for another and acts on its behalf in a market where that second bank has no presence. It sounds administrative, but it quietly holds up the entire global payment system. No bank can open branches and join every country's clearing system on its own. So instead, it opens an account with a bank already established there. That local correspondent executes instructions, holds balances, and provides access the first bank could never build alone. The mechanism runs on accounts held in each other's names. A bank keeps a balance at its correspondent, instructs payments against it, and tops it up as needed. And because transactions flow both ways, only the net difference has to move. But correspondent banking has a cost worth naming. Each additional bank in the chain adds a fee, a delay, and a compliance checkpoint. So a payment routed through several correspondents can take days and lose value along the way. This structural friction is exactly what payments fintechs built their businesses around. Remember, correspondent banking means two separate banks cooperating, with one absent from the market in question. Unlike single institution transfers or competitive unbundling, ask whether the firms are helping each other or competing, and the concept sorts itself out immediately. Question 8. An auditor reviewing a merchant bank's records notices that every transaction appears twice, once as a debit and once as a matching credit, which makes it far easier to catch errors or fraud. Which merchant banking innovation does this describe? Your options are A. The bill of exchange, B. correspondent banking, C. commodity money, D. double entry bookkeeping. Got a guess? Lock it in? The correct answer is D. Double entry bookkeeping. D is correct because double entry bookkeeping records each transaction as a matched debit and credit, which is what makes a firm's books auditable in the first place. Merchant banks introduced the method and passed it to commerce generally. The matched pair described in the scenario is the defining feature. A is wrong because a bill of exchange is a written order to pay used to move value between cities without moving metal. It is a financial instrument, not a method of recording transactions. B is wrong because correspondent banking is an arrangement in which one bank acts for another where the second has no presence. It governs relationships between institutions rather than how entries are recorded. C is wrong because commodity money is a shared unit of value such as grain, cattle, or metal. It predates merchant banking entirely and has nothing to do with audit trails. For most of history, fraud hid easily in the books. A single entry list of amounts gave reviewers no way to check whether an entry was real, mistaken, or invented. So merchant banks needed something better. Double entry bookkeeping records every transaction as a matched debit and credit, so the two sides always balance. Buying inventory reduces cash and increases inventory. Taking a loan increases cash and increases liabilities. The system captures not just what happened, but where the value came from and where it went. An invented entry must be balanced by another invented entry that has to appear somewhere plausible, and errors reveal themselves the moment the books stop balancing. That traceability is what makes accounts auditable. That auditability is the precondition for a stranger being willing to invest in, lend to, or partner with a business they cannot personally observe. A merchant bank in Florence could deal with a partner in Bruges because both kept checkable books, and every later system built on outsider trust, from securities markets to bank regulation, inherits this verifiability. A bill of exchange pays across distance, and correspondent banking is a relationship between institutions. But double entry bookkeeping is neither. It's a recording method, so whenever a STEM asks about something being recorded, checked, or verified, matched debits and credits are the signal to look for. Question 9. A 17th century London goldsmith observes that depositors almost never withdraw their stored gold at the same time. He begins lending out more than he physically holds in the vault while keeping enough on hand to meet ordinary withdrawal demand. Which practice has he adopted? Your options are A. Fractional reserve banking, B. Correspondent banking, C. Underwriting, D. Merchant banking. Which one is it? Pause the video if you need more time. The correct answer is A. Fractional reserve banking. A is correct because fractional reserve banking holds only a fraction of depositors' funds in reserve and lends out the remainder, on the assumption that not all depositors will demand their funds at once. The goldsmith's observation about withdrawal behavior is the exact origin of the practice. It remains the operating model of virtually every commercial bank today. B is wrong because correspondent banking involves one bank holding deposits for another in a location where the second has no presence. There is no second institution anywhere in this scenario. C is wrong because underwriting is the investment banking activity of pricing and reselling a new securities issue while absorbing placement risk. The goldsmith is lending against deposits, not placing securities. D is wrong because merchant banking is the provision of capital, credit, and payment services to merchants engaged in trade. The practice described here concerns reserve levels rather than trade finance. In the 1600s, London goldsmiths storing gold for customers noticed something simple. Depositors almost never came for their gold all at once. That quiet observation became the foundation of modern banking. Fractional reserve banking means a bank keeps only a fraction of deposits as reserve and lends out the remainder, betting that withdrawal demand stays ordinary rather than all at once. This is the standard legal operating model for nearly every commercial bank. Only a small slice of deposit stays in the vault. The rest becomes loans. That transforms idle savings into working capital, expanding credit far beyond the physical stock of money and financing growth that otherwise couldn't happen. The trade-off is structural. Reserves are sized for normal withdrawals, not a stampede, so the whole system depends on depositor confidence. That's exactly why central banks act as lender of last resort and deposit insurance exist, both engineered to stabilize this fragility. Fractional reserve banking isn't fraud or insolvency. Its real risk is a confidence-driven bank run. Remember, it's about how much of the deposit base stays on hand, not about who the customer is. Question 10. A commercial bank that has followed every regulation and holds a sound loan book still cannot pay every depositor immediately when a rumor prompts most of them to demand their money in the same week. What does this outcome reveal about the fractional reserve model? Your options are: A. The bank has been committing fraud by lending out depositor funds. B. The bank must have violated its deposit insurance requirements. C. The model depends on depositor confidence because reserves are sized for ordinary demand rather than simultaneous demand. D. The model only breaks down at banks that were already insolvent. Take a second. Which answer would you pick? The correct answer is C. The model depends on depositor confidence because reserves are sized for ordinary demand rather than simultaneous demand. C is correct because fractional reserve banking assumes depositors will not all withdraw at once, so reserves are sized to cover ordinary withdrawal demand. When confidence breaks and demand becomes simultaneous, no fractional reserve bank can honor every withdrawal immediately, no matter how well it is managed. That built-in fragility is exactly why central banks and deposit insurance were created. A is wrong because lending out depositor funds is the normal, legal operating model of commercial banking rather than wrongdoing. Confusing the model with fraud is one of the most common traps on this material. B is wrong because deposit insurance protects depositors up to a set limit and never required banks to hold all deposits as idle cash. Nothing in the scenario suggests any rule was broken. D is wrong because the scenario specifies a sound loan book, which rules out insolvency as the trigger. A run can strike a fully solvent bank purely because confidence collapsed. Bank runs don't happen to bad banks, they happen to fragile banks. And under fractional reserve banking, every bank is fragile in the same specific way, even the well-managed ones with sound loans and full regulatory compliance. The mechanism is simple arithmetic. Reserves cover normal daily withdrawals, but the rest of the money is out in loans that can't be called back. If everyone demands cash at once, the bank can be solvent and still unable to pay, because solvency and liquidity are not the same thing. What turns a normal week into a run is confidence, not arithmetic. If you suspect others will withdraw, you have every reason to withdraw first, since the last in line gets nothing, which is why runs accelerate violently once they start. Two institutions exist to interrupt that panic. Deposit insurance removes the incentive to race for the door, and a central bank, as lender of last resort, turns an illiquid bank liquid before the run finishes. That's why incumbent trust, built over decades, is such a hard asset for a new fintech to replicate. Keep insolvency and illiquidity separate. One is a balance sheet problem. The other is a timing problem. And a run is a liquidity event, not evidence of wrongdoing. Question 11. A finance student is asked to identify the institution that became the template for the modern central bank, empowered to issue currency, manage the money supply, and stand behind the banking system in a crisis. Which institution fits that description? Your options are A. The Federal Reserve System, founded in 1913. B. The Bank of England, founded in 694. C. The International Monetary Fund, founded in 1944. D. SWIFT, founded in 1973. Before I reveal it, which one do you think is right? The correct answer is B. The Bank of England, founded in 1694. B is correct because the Bank of England was founded in 1694, initially to help finance the English government's war debt, and became the model that other nations later followed. Its combination of currency issuance, monetary management, and support for the banking system is what defines a central bank. Every later central bank, including the Federal Reserve, was built on that template. A is wrong because the Federal Reserve is the US central bank, but it was created in 1913, more than 2 centuries after the template already existed. The United States was in fact a late adopter of central banking. C is wrong because the International Monetary Fund was created under the Bretton Woods Agreement in 1944 to help manage an international monetary system. It is a multilateral body rather than a national central bank. D is wrong because SWIFT is a 1973 cooperative that standardized secure interbank messaging worldwide. It carries instructions between banks and has no currency issuance or monetary policy authority. America resisted the idea of a central bank for over a century, letting 2 earlier national banks expire because of a deep distrust of concentrated financial power. The result was a 19th century of recurring banking panics with no institution standing behind the system. And only a crisis severe enough to be unbearable brought the Federal Reserve into existence in 1913. A central bank is the national institution overseeing a country's monetary system, and 4 functions define that role: issuing currency, setting monetary policy, supervising banks, and acting as lender of last resort during a crisis. The Bank of England, founded in 1694 to help finance a war debt, became the template other nations later copied. The reason this institution has to exist traces back to fractional reserve banking, a system where every bank holds only a portion of deposits in cash. That works fine in ordinary conditions, but individual banks cannot rescue each other in a panic because the crisis hits everyone simultaneously. So something outside the commercial banking system has to be able to create currency and step in. The distinction that trips people up most is central bank versus commercial bank. A central bank doesn't take retail deposits or chase consumer accounts. It serves the banking system and the currency itself, while a commercial bank takes deposits from the public and lends them out to earn a net interest margin. Monetary policy moves lending costs through interest rates and supervision sets the capital rules that make incumbent banks slower and more cautious than upstart fintechs. Whenever a STEM mentions issuing currency, setting rates, supervising banks, or rescuing the system in a crisis, it's describing a central bank. Question 12. Repeated banking panics through the 1800s culminated in a 1907 crisis severe enough that a private banker organized a rescue of the banking system before the federal government acted. Congress responded by creating the Federal Reserve System in 1913. Which recurring pattern in financial services does the sequence illustrate? Your options are: A. New technology arrives first and regulation follows to accommodate it. B. Private capital reliably prevents the need for public regulation. C. Deregulation predictably follows extended periods of stability. D. A crisis exposes a structural weakness and regulation follows to patch it. What's your answer? Commit to one before I continue. The correct answer is D. A crisis exposes a structural weakness and regulation follows to patch it. D is correct because the Panic of 1907 exposed the absence of any institution capable of backstopping the banking system, and the Federal Reserve Act of 1913 was the regulatory patch for that gap. This crisis, then reform sequence repeats throughout the industry's history, from the Great Depression through the 2008 crisis. Recognizing the pattern matters more than memorizing any single date. A is wrong because technology has repeatedly driven change in banking, but this particular sequence was triggered by a panic rather than an invention. No new technology prompted the Federal Reserve Act. B is wrong because the private rescue organized in 1907 is precisely what convinced Congress that depending on private intervention was unsustainable. The episode argues against the claim rather than supporting it. C is wrong because deregulation did occur in some eras, most notably with Gramm-Leach-Bliley in 1999. It is not what happened here, where a crisis produced more regulation rather than less. Financial regulation almost never comes from careful advanced planning. It arrives after something breaks, shaped by exactly what broke, and recognizing that pattern predicts the timing and content of nearly every major law in this course. The clearest illustration runs from the Panic of 1907 to the Federal Reserve Act of 1913. A private banker personally rescued the banking system before Washington acted, and that spectacle convinced Congress to build a permanent institution instead of depending on a wealthy individual's goodwill. The sequence repeats with different actors. The 1929 crash produced Glass-Steagall. The savings and loan crisis produced consolidation and tighter supervision, and the global financial crisis produced Dodd-Frank with higher capital requirements and new oversight bodies. Regulation is expensive and unpopular while conditions are calm because its costs are visible and its benefits are only hypothetical. A crisis converts that hypothetical into something demonstrated, which is the only reliable way the political cost of acting finally drops below the cost of doing nothing. Post-crisis rules also slow down incumbents and create space for challengers like Fintech to expand. And remember, the pendulum swings both ways. Gramm, Leach, Bliley loosen rules during calm years, proving that quiet periods erode restrictions until the next crisis proves them necessary again. Question 13. During a liquidity crisis, otherwise sound banks cannot obtain short-term funding and risk failing purely because credit markets have frozen. A national institution steps in and lends to them so the system keeps operating. Which central bank role is being performed? Your options are: A. Underwriter of new securities issues. B. Correspondent bank for foreign institutions. C. Lender of last resort. D. Insurer of individual deposit accounts. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C, lender of last resort. C is correct because acting as lender of last resort means supplying credit to institutions when normal funding sources have dried up, which keeps a confidence-dependent system from collapsing. The role sits alongside issuing currency, setting monetary policy, and supervising banks as a defining central bank function. The scenario describes that backstop precisely. A is wrong because underwriting new securities issues is investment banking work performed for corporate and government issuers. Central banks do not price and resell corporate securities. B is wrong because a correspondent bank holds deposits for and acts on behalf of another bank where the second has no presence. That is a commercial arrangement between private institutions, not a crisis backstop. D is wrong because deposit insurance protects individual depositors up to a set limit, and in the United States is administered by the FDIC. It reassures depositors rather than lending to banks. Imagine a bank whose loans are sound, whose capital is adequate, and whose depositors are calm, yet it suddenly cannot borrow. The funding markets it relies on have frozen, not because the bank behaved badly, but because the plumbing of the system seized up. A solvent institution can still collapse if no one is willing to lend into that freeze. Lender of last resort is one of 4 defining central bank roles, alongside issuing currency, setting monetary policy, and supervising banks. When ordinary funding dries up, the central bank steps in, so a temporary liquidity failure doesn't turn into a permanent insolvency. The classic rule is to lend freely against good collateral at a penalty rate. Lending freely stops the panic, since a run only works if the money might actually run out. Good collateral protects public funds, and a penalty rate keeps banks from treating rescue as ordinary funding. The key distinction is between illiquidity and insolvency. Lender of last resort support is meant for institutions that are solvent but temporarily unable to convert assets into cash. An institution that truly owes more than it owns is a different problem entirely, one that lending cannot solve. A guaranteed rescue can encourage the very risk-taking that makes rescues necessary. This is moral hazard, managed through capital requirements, liquidity rules, and supervision. And remember the closest confusable concept: deposit insurance protects depositors directly, while lender of last resort lends to the institution itself, funding it through the freeze. Question 14. In 1973, banks worldwide gained a cooperative messaging standard that let any member institution instruct another to move money using a common, secure format, regardless of country. Which development does this describe? Your options are the founding of SWIFT, B, the Bretton Woods Agreement, C, the spread of the automated teller machine, D, the passage of the Gramm-Leach-Bliley Act. Which would you go with? Lock it in before the reveal. The correct answer is A, the founding of SWIFT. A is correct because SWIFT, the Society for Worldwide Interbank Financial Telecommunication, was founded in 1973 as a cooperative messaging standard for banks anywhere in the world. It allowed institutions to instruct each other securely in a shared format, which made global payments workable at scale. It is often described as an early fintech, decades before the term existed. B is wrong because the Bretton Woods Agreement of 1944 pegged major currencies to the dollar and created the International Monetary Fund and the World Bank. It established exchange rate architecture rather than a messaging standard. C is wrong because automated teller machines spread through the 1970s and 1980s and removed the human teller from routine retail transactions. They changed customer-facing banking, not the format banks use to instruct each other. D is wrong because Gramm-Leach-Bliley is a 1993 US law permitting financial holding companies to combine banking, securities, and insurance. It is legislation rather than a communication standard. Before 1973, sending money between banks in different countries meant telex messages, private formats, and one-off agreements between each pair of institutions. Every ambiguity meant a payment that arrived late, wrong, or not at all. SWIFT is a cooperative owned by the banks that use it, providing one shared format for banks to instruct each other. The key insight is what it doesn't do. It carries messages, but it does not hold accounts, move funds, or settle anything. Separating instruction from settlement is the whole design. When one bank instructs another through SWIFT, the message travels through the network, but the actual value still moves through correspondent accounts, exactly as before. Exam stems confuse SWIFT with three neighbors. Bretton Woods from 1944 is monetary policy, not technology. The ATM changed customer-facing banking, not interbank messaging. And correspondent banking is the account relationship where value actually moves, while SWIFT is only the instruction. Because a standard's value grows with participation. SWIFT was built as a cooperative rather than owned by one bank, letting it scale globally without forcing any country to change its domestic system. Question 15. After World War II, major currencies were pegged to the US dollar, which was itself pegged to gold, under an architecture that also created the International Monetary Fund and the World Bank. In 1971, the United States ended the dollar's convertibility into gold. What was the direct consequence for currency markets? Your options are: A. Global currency trading effectively came to an end. B. Major currencies moved to floating exchange rates, turning currency trading into a substantial business of its own. C. The Federal Reserve was created to manage exchange rates. D. SWIFT was dissolved and replaced by separate national messaging systems. Don't overthink it. Which one feels right? The correct answer is B. Major currencies moved to floating exchange rates, turning currency trading into a substantial business of its own. B is correct because ending convertibility severed the fixed link between the dollar and gold, and the words major currencies moved to floating exchange rates. Once rates floated, currency values moved continuously, which made foreign exchange a business in its own right. That shift is the origin of modern global currency trading. A is wrong because currency trading expanded rather than disappeared, because floating rates created constant price movement to trade around. The end of the peg increased activity substantially. C is wrong because the Federal Reserve was created in 1913 following the Panic of 1907, nearly 6 decades earlier. Its founding had nothing to do with the collapse of Bretton Woods. D is wrong because SWIFT was founded in 1973, 2 years after convertibility ended, and it continues operating today. It was never dissolved or replaced. After World War II, the world tried to prevent another round of currency chaos by building a formal monetary system. What it built and how it broke still shapes currency markets today. The design was simple. Major currencies were fixed to the dollar and the dollar was fixed to gold. 2 institutions managed it: the IMF, which lent to countries in balance of payments trouble, and the World Bank, which financed reconstruction and development. The flaw was structural. Honoring gold conversion requires enough gold on hand, but the world's dollar holdings kept growing past what gold could back. Just like a bank run, the promise only survived as long as people believed it. And in 1971, the United States ended convertibility, breaking the fixed system. Once the gold peg broke, major currencies moved to floating exchange rates, meaning their value is set continuously by supply and demand rather than by government commitment. That single shift is the birth of modern foreign exchange trading as a business. Corporations now need hedging. Banks earn spreads on conversion, and fintechs compete over that spread. A whole industry born from one policy choice in 1971. Remember, Bretton Woods governs what currencies are worth, while SWIFT and correspondent banking govern how the money actually moves. Question 16. A regional bank earns most of its profit from the gap between the interest it collects on mortgages and business loans and the interest it pays out on customer deposits. Which sector and revenue model does this describe? Your options are A. Investment banking earning trading profit. B. Wealth management earning advisory fees. C. Investment banking earning underwriting spreads. D. Commercial banking earning a net interest margin. Got a guess? Lock it in. The correct answer is D. Commercial banking earning a net interest margin. D is correct because net interest margin is the difference between interest income earned on loans and investments and interest paid on deposits and borrowings, measured against earning assets. It is the core profit engine of commercial banking, the sector that takes deposits and lends them out. The scenario describes that spread exactly. A is wrong because trading profit comes from making markets and holding positions in capital markets instruments, which is investment banking work. No trading activity appears anywhere in the scenario. B is wrong because wealth management earns advisory or management fees for investment advice and portfolio management provided to individuals. A fee on managed assets is a fundamentally different model from an interest spread. C is wrong because underwriting spreads are earned when an investment bank prices, buys, and resells a new securities issue. The bank described as originating loans, not placing securities with investors. Commercial banking runs on one simple piece of arithmetic: borrow cheap from depositors, lend dear to borrowers, and keep the difference. That gap is called the net interest margin. What's earned on loans and investments, minus what's paid on deposits and borrowings as a share of earning assets. Almost every strategic move a bank makes traces back to protecting or widening this margin. Deposits flow in at a low rate, loans flow out at a higher one, and the bank captures the spread in between. This is why deposits are treated as strategically vital, even though they sit on the liability side. Losing deposits means losing the raw material the whole business depends on. This is also the key to telling the three sectors apart. Commercial banking earns an interest spread from consumers and businesses. Investment banking earns underwriting, advisory, and trading fees from corporations and institutions. Wealth management earns fees on assets under management from individuals. Function and revenue model classify a business, not its corporate parent. If the profit comes from a spread between two interest rates, that's commercial banking, even inside a giant financial holding company. Question 17. A firm helps a manufacturer issue 500 million in new bonds. It sets the price, purchases the issue, and resells it to investors, absorbing the risk that the bonds might not sell at the expected price. Which sector and activity does this represent? Your options are A. Investment banking performing underwriting. B. Commercial banking extending a syndicated loan. C. Wealth management performing portfolio construction. D. Central banking conducting monetary policy. Which one is it? Pause the video if you need more time. The correct answer is A. Investment banking performing underwriting. A is correct because underwriting is the process by which an investment bank prices, purchases, and resells a new issue of securities on behalf of the issuer while absorbing placement risk. Helping a corporation raise capital through a securities issue is a defining investment banking function. The detail about absorbing the risk of an unsuccessful sale is the strongest tell. B is wrong because a syndicated loan is credit extended by a group of lenders and stays on lender balance sheets. The scenario describes securities sold to outside investors rather than a loan held by banks. C is wrong because portfolio construction assembles investments for an individual client based on goals and risk tolerance. Its client is an individual investor, not a corporation raising capital. D is wrong because monetary policy involves a central bank managing money supply and interest rates for an entire economy. No central bank participates in pricing a corporate bond issue. When a company needs hundreds of millions of dollars for a new plant, borrowing from banks is slow and concentrates risk. So instead, it turns to the capital markets and to the investment bank that makes issuing bonds or stock possible. Investment banking means helping corporations and governments raise capital by issuing securities, advising on mergers and acquisitions, and making markets. Its clients are corporate and institutional, not retail. So there's no branch to walk into, and revenue comes from spreads and fees, not interest margins. Underwriting means the bank prices, purchases, and resells the new issue itself, absorbing the risk that it might not sell. This is not simple brokering. The bank takes the securities onto its own books, transferring placement risk from issuer to bank in exchange for the underwriting spread. Pricing an issue is the real skill. Too high and it doesn't sell. Too low and the issuer raises less than it should and the bank's reputation suffers. M&A advisory earns fees tied to deal completion, while market making earns the bid-offer spread for continuously standing ready to trade. Watch for exam stems about raising capital, pricing a new issue, merger advice, or trading for institutions, with absorbing unsold risk pointing straight to underwriting. Even crowdfunding platforms compete here, because any platform that raises capital from investors is playing on investment banking's turf. Question 18. A firm earns nearly all of its revenue from a percentage fee charged on the assets it manages for individual clients, and it delivers financial planning alongside portfolio management. Which sector does this firm belong to? Your options are A. Commercial banking, B. Investment banking, C. Wealth management, D. Correspondent banking. Take a second. Which answer would you pick? The correct answer is C. Wealth management. C is correct because wealth management provides investment advice, portfolio management, and financial planning to individuals, earning advisory or management fees calculated on assets. An asset-based fee charged to individual clients is the clearest identifying signal of the sector. Both the customer type and the revenue model point the same way. A is wrong because commercial banking takes deposits and makes loans, earning a net interest margin on the spread. Neither deposit taking nor lending appears in the scenario. B is wrong because investment banking serves corporations, governments, and institutions through capital raising, advisory work, and trading. Its clients are not individuals receiving financial plans. D is wrong because correspondent banking is an arrangement between two banks rather than a customer-facing sector of the industry. It produces no asset-based advisory fee. The fastest way to spot wealth management on an exam is the revenue model. It's a recurring percentage fee on assets managed for an individual client, not an interest spread and not an underwriting fee. Commercial banking touches nearly everyone with a thin margin on huge volume, and investment banking touches few clients but earns large one-time fees. Wealth management sits in between, built on recurring revenue from ongoing relationships rather than a single transaction. Because the fee is a percentage of assets, the manager's revenue moves in lockstep with the client's wealth. That alignment is genuinely valuable, but it also means a market downturn hits the manager's income right when clients are most nervous. Historically, wealth management meant a dedicated advisor delivering investment advice, tax planning, and trust and estate work. A small percentage fee on a very large portfolio comfortably supports that advisor, but the same percentage on a modest portfolio doesn't even cover the time for one annual meeting. Even when a bank holding company owns a wealth management arm, it's still classified by what it does, an asset-based fee charged to individuals. Read the stem for function, customer, and revenue model, and the sector reveals itself every time. Question 19. A platform asks new clients a short series of questions about risk tolerance and financial goals, then uses an algorithm to build and rebalance a diversified portfolio with essentially no human advisor involved. What is this platform and where does it compete? Your options are: it's a correspondent bank competing within commercial banking. B, an underwriter competing within investment banking. C, a central bank facility operating outside the three sectors. D, a robo-advisor competing within wealth management. Before I reveal it, which one do you think is right? The correct answer is D, a robo-advisor competing within wealth management. D is correct because a robo-advisor is an automated investment platform that builds and manages a portfolio from a client's answers to a risk and goals questionnaire with little or no human advisor involvement. Because it delivers investment advice and portfolio management to individuals, it competes directly inside wealth management. It is the clearest example of technology driving advisory cost down and broadening access. A is wrong because correspondent banking is an interbank arrangement for operating where one bank has no presence. It plays no role in constructing portfolios for individuals. B is wrong because an underwriter prices and resells new securities issues for corporate or government issuers. That activity has nothing to do with managing an individual's portfolio. C is wrong because central bank facilities support the monetary system and the banking sector rather than serving retail investors. A robo-advisor sits squarely inside one of the three sectors. A robo-advisor is an automated investment platform that builds and manages a diversified portfolio using algorithms with little or no human advisor involved. The definition sounds modest, but it actually represents the collapse of a cost structure that had defined wealth management for centuries. A client answers a questionnaire about time horizon, goals, and reaction to losses, which maps to a risk profile and then to a target allocation across low-cost index funds. Software then handles the ongoing work an advisor used to do, rebalancing drift, reinvesting dividends, and sometimes harvesting tax losses. Nearly all the cost in traditional wealth management was the advisor's time, and the questionnaire plus allocation logic replaces most of what that time was spent on. Fees drop dramatically, and a customer with a modest balance suddenly becomes worth serving, opening a market the old pricing model excluded. Algorithmic allocation handles the rule-based, repeatable portion of advice, but it doesn't handle a client deciding whether to sell a family business, navigating a divorce settlement, or panicking during a market decline. Human advice hasn't disappeared. It's been pushed toward the complicated situations where judgment actually earns its fee. A robo-advisor competes inside wealth management rather than forming its own category. It's fintech in how it's delivered and wealth management in what it does. That's why traditional advisors cutting fees after an automated competitor arrives is really a story about fee compression, not about the technology itself. Question 20. An instructor traces one modern sector back to a practice that began by financing merchants engaged in trade and gradually evolved into managing the accumulated wealth of those merchants and their families. Which modern sector is being traced? Your options are: A, commercial banking; B, wealth management; C, investment banking; D, central banking. What's your answer? Commit to one before I continue. The correct answer is B, wealth management. B is correct because merchant banking began as capital, credit, and payment services for traders. And over centuries, it evolved into managing the wealth those trading families accumulated. That line of descent is why wealth management is traced specifically to merchant banking. Much later, technology broadened the sector from the very wealthy to a mass market audience. A is wrong because commercial banking descends more directly from deposit taking and lending, including the goldsmith practice that produced fractional reserve banking. Its defining activity is the deposit and loan spread, not managing family wealth. C is wrong because investment banking grew out of raising capital and trading securities for corporate and government issuers. Its client base was never individual families managing accumulated personal wealth. D is wrong because central banking emerged to oversee monetary systems and backstop fragile banking systems, usually after a crisis. It is a public function rather than a descendant of merchant trade finance. A straight line runs from 15th century Florentine bankers to the wealth management app on your phone today, and that line explains why the industry behaves the way it does. Merchant banking began by funding merchants' trade rather than serving everyday savers. As those merchants grew wealthy, the bank that already knew their business became the natural steward of that wealth, and the service expanded into comprehensive, personal, high-touch advice for the very rich. That personal, relationship-based model carried rich margins straight into the 20th century Wall Street private bank. But rich margins attract competition, and a robo-advisor needs no relationship at all, which is exactly the assumption merchant banking's heirs never questioned. Keep the three lineages straight. Commercial banking traces to deposit taking and lending through the London goldsmiths. Investment banking traces to raising capital and trading securities for issuers, and only wealth management traces back to merchant banking. Whenever a stem describes trade finance evolving into stewardship of family wealth, that lineage points to wealth management specifically. Question 21. A crowdfunding platform lets small companies raise capital directly from many individual investors, bypassing the traditional process of hiring a bank to price and place a securities issue. Which sector's business is this platform competing against? Your options are A. Commercial banking, B. Wealth management, C. Investment banking, D. Central banking. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Investment banking. C is correct because investment banking's core business is helping corporations and governments raise capital, traditionally by underwriting stock and bond issues. A crowdfunding platform performs the same economic function of connecting an issuer to investors, just without the underwriting bank in the middle. That is why crowdfunding and other alternative capital raising platforms are treated as pressure on investment banking specifically. A is wrong because commercial banking takes deposits and makes loans, earning a net interest margin on the spread. Raising equity from a crowd of investors is neither deposit taking nor lending. B is wrong because wealth management provides investment advice and portfolio management to individuals for a fee. The platform serves companies seeking capital, not individuals seeking advice. D is wrong because central banking oversees the monetary system, sets policy, and backstops the banking system. It does not compete for corporate capital raising business. A small hardware company needs a few $100,000, too small for an investment bank and too risky for a loan, so it turns to a crowdfunding platform instead. To classify this correctly, we have to ignore how it looks and ask what it actually does economically. Investment banking means helping organizations raise capital by issuing securities, advising on mergers and acquisitions, and making markets. A crowdfunding platform performs the first function through software instead of a banker, connecting organizations that need capital to people willing to supply it. It competes on investment banking territory even though it looks like a consumer website. Traditional underwriting means a bank prices, buys, and resells an issue to institutions, which requires costly relationships and balance sheet capacity. A platform substitutes software for that, matching thousands of small contributions against one funding target. Reaching 1,000 small investors used to be prohibitively expensive. Software made it trivial. This is disruptive innovation run into pattern. Platforms started with companies no bank would meet with, then moved upmarket as they built track records. Two sectors get chosen by mistake on exam stems. Commercial banking involves deposits and loans, while wealth management involves advice for individuals investing their own savings. Crowdfunding is defined by an organization seeking capital from many small investors, which is the hallmark of capital raising. Whatever the platform looks like, if an organization is raising capital from investors, it belongs to investment banking's territory. Question 22. During a study session, a classmate describes the structure of financial services as 4 sectors: commercial banking, investment banking, wealth management, and fintech. What is the flaw in that description? Your options are: A. Fintech is a cross-cutting approach that competes inside all 3 sectors rather than a sector of its own. B. Fintech belongs on the list, but wealth management does not. C. There are really only 2 sectors because investment banking is a part of commercial banking. D. Fintech should replace commercial banking, which no longer exists as a distinct business. Which would you go with? Lock it in before the reveal. The correct answer is A. Fintech is a cross-cutting approach that competes inside all 3 sectors rather than a sector of its own. A is correct because fintech is the use of technology to deliver financial services more cheaply, quickly, conveniently, or accessibly, and it appears inside every sector rather than beside them. A payments fintech competes on commercial banking's turf, a robo-advisor on wealth management's, and a crowdfunding platform on investment banking's. Listing it as a 4th sector is one of the most frequently tested errors on this material. B is wrong because wealth management is one of the 3 established sectors defined by investment advice and portfolio management for individuals. Removing it would leave the industry structure incomplete. C is wrong because commercial and investment banking differ in function, customer base, and revenue model, and were legally separated for 6 decades. Collapsing them misstates how the industry is organized. D is wrong because commercial banking remains a large, distinct business built on deposits, loans, and payments. Fintech pressures that business rather than replacing it. The most common mistake students make is treating fintech as a 4th sector alongside commercial banking, investment banking, and wealth management. Let's see exactly why that's a category error. Sectors are defined by what a business does, who it serves, and how it earns money. Commercial banking, investment banking, and wealth management each answer these 3 questions with a genuinely different answer. Fintech is short for financial technology, and it describes a method of delivery, not a function, a customer, or a revenue model. That's why it can't stand beside the other 3 sectors as an equal. In practice, fintech shows up inside every sector rather than beside them. A payments company competes on commercial banking's turf. A robo-advisor competes on wealth management's turf. And a crowdfunding platform competes on investment banking's turf. The right first move with any fintech competitor is asking which sector it's actually attacking, since that determines the correct response. And keep fintech distinct from disruption. Fintech names how a service is delivered, while disruption names how a market position is taken. Question 23. 2 analysts disagree about a bank's fintech strategy. One argues that all fintech threats can be met with a single industry-wide response. The other argues that a robo-advisor and a peer-to-peer lender demand different responses. Which reasoning better reflects how fintech disruption actually works? Your options are: A. The first analyst because fintech competes with the industry as an undifferentiated whole. B. The second analyst because each fintech attacks one specific sector with its own customers, economics, and defenses. C. The first analyst because all fintechs share essentially the same revenue model. D, the second analyst, because robo-advisors are regulated as banks while lenders are not. Don't overthink it. Which one feels right? The correct answer is B, the second analyst, because each fintech attacks one specific sector with its own customers, economics, and defenses. B is correct because each sector has a different customer base, revenue model, and competitive dynamic. So a fintech attacking wealth management is playing a different game from one attacking commercial lending. A robo-advisor pressures advisory fees on individual portfolios, while a peer-to-peer lender pressures loan pricing and underwriting economics. A single blanket response would misfire against at least one of them. A is wrong because the three sectors remain functionally distinct even inside a combined financial holding company. Treating the industry as undifferentiated is exactly the error the sector model exists to prevent. C is wrong because fintechs do not share one revenue model, since a robo-advisor earns asset-based fees while a lender earns interest and origination income. The premise of this answer is false. D is wrong because the second analyst is right, but not for this reason. Robo-advisors are not regulated as banks, and the real basis for the conclusion is sector-specific competition. Financial services isn't one business with one competitive threat. Each sector runs on different economics, which means fintech competition demands a different defense depending on where it strikes. In commercial banking, entrants attack the interest spread by offering better rates. In wealth management, they undercut the recurring fee with cheaper portfolio management. In investment banking, they bypass the transaction fee entirely by matching issuers to investors without needing the bank's distribution. Against a deposit gatherer, the bank competes on rate, convenience, or breadth of service. Against a robo-advisor, matching price alone erodes margins forever, so partnering for comparable technology usually makes more sense. Against a platform serving customers the bank never wanted, the smartest move may be no fee at all, just a referral fee. A modern app doesn't stop a rejected borrower from getting funded elsewhere, and it doesn't stop an advisor platform from charging a tenth of the price. Diagnosis has to come before treatment, and that diagnosis is sector-specific. The sector tells you which asset is at risk, but the right response still depends on the specific fintech, not the category it belongs to. Sector identification narrows the field of answers. It never selects the final one for you. Question 24. A wealth management sector that once served only very wealthy individuals through dedicated human advisors now reaches mass market customers at a small fraction of the former cost. Which mechanism best explains that shift? Your options are: A. Regulators required firms to begin serving smaller accounts. B. Advisory fees rose, which funded broader service coverage. C. Commercial banks absorbed the sector and subsidized it with deposit funding. D. Data and algorithm-driven advice pushed the cost of advisory work sharply down. Got a guess? Lock it in. The correct answer is D. Data and algorithm-driven advice pushed the cost of advisory work sharply down. D is correct because technology, specifically data and algorithmic portfolio construction, shifted much of the advisory work off the human advisor and onto software. That collapsed the cost of delivering advice, which made customers who could never justify a private banker's fee economically worth serving. The same pattern of lower cost broadening access recurs across every sector in this course. A is wrong because no regulatory mandate forced firms to serve smaller accounts. The change was driven by economics, not by rule. B is wrong because fees came down rather than up, and falling fees are precisely what opened the sector to a broader audience. Rising fees would have narrowed the customer base further. C is wrong because wealth management stays a distinct business even where a holding company owns all three sectors. Deposit funding does not explain algorithm-driven cost reduction in advice. There's a single sequence that repeats across every sector in this course, and once you can see it, it becomes the most powerful predictive tool you have. Technology lowers the cost of delivering a service. Lower cost makes previously unprofitable customers worth serving, which increases competition at the low end. That competition then forces incumbent pricing down across the entire market. The precise mechanism matters. A human advisor serving one more client burns hours that are gone forever, while software serving one more client costs almost nothing. That gap in marginal cost, not any improvement in advice quality, is what actually opens a market. In lending, automated underwriting on alternative data made small loans cheap to evaluate. In payments, software replaced manual underwriting and hardware setup. In every case, the barrier was cost of service, not lack of demand. Fee compression is just the final link in the chain, not the chain itself. And the pattern isn't pure gain. Broadening access truly helps excluded customers, but it also means judgment and accountability are replaced by systems that have neither. Question 25. An exam scenario describes a firm whose income comes almost entirely from a fee charge for managing client portfolios. A student classifies it as commercial banking because the firm is owned by a bank holding company. Why is that classification wrong? Your options are: A. Sector classification follows function and revenue model, and a fee for managing portfolios is wealth management. B. Sector classification follows ownership, and the student applied the ownership rule incorrectly. C. The firm should be classified as investment banking because portfolios hold securities. D. Firms owned by holding companies cannot be placed in any sector at all. Which one is it? Pause the video if you need more time. The correct answer is A. Sector classification follows function and revenue model, and a fee for managing portfolios is wealth management. A is correct because sectors are defined by what a business does, who it serves, and how it earns money, not by which holding company owns it. A fee charge for managing an individual's portfolio is the wealth management revenue model, while commercial banking earns a net interest margin on deposits and loans. Even inside a combined institution, the three sectors are typically operated, capitalized, and regulated as distinct businesses. B is wrong because ownership is exactly what should not drive the classification. Graham Leach Bliley allowed one holding company to own all three sectors without merging their functions. C is wrong because holding securities inside a client portfolio does not make the activity investment banking, which raises capital and trades for corporate and institutional clients. The customer here is an individual receiving advice. D is wrong because any operating business can be classified by function and revenue model, regardless of its corporate parent. Holding company ownership does not remove a firm from the sector framework. In 1999, Graham Leach Bliley let one holding company own a commercial bank, an investment bank, an insurer, and a wealth manager all at once. You might think that ended the three-sector model. It didn't, and understanding why is the key to reliable scenario classification. Legal permission to combine never changed the underlying economics. A lending operation still earns an interest spread, an underwriting desk still earns fees, and an advisory arm still earns a percentage of assets. Those are three different ways of making money from three different customer bases, even under one parent. Combined institutions keep these businesses separate on purpose. Each is capitalized differently for its own risks, regulated by rules written for its specific activity, like the Volcker rule restricting trading at deposit-taking banks, and run with different expertise and systems. The holding company is just a legal wrapper around distinct businesses. The rule is simple: identify what the business actually does, who its customers are, and where its revenue comes from. Those three answers determine the sector. not corporate ownership and not the name on the building. This is why fintech disruption hits sector by sector, not company by company, and why exam stems dangle ownership as a distractor. Don't treat fintech as a fourth sector or a conglomerate as one business. Both mistakes classify by appearance instead of function. Question 26. In the early 20th century US, commercial banks were also underwriting and trading securities, at times using depositor funds to do it. After the 1929 crash and the wave of bank failures that followed, Congress barred a single institution from both taking deposits and dealing in most securities. Which law accomplished this? Your options are A. The Dodd-Frank Act, B. The Gramm-Leach-Bliley Act, C. The Glass-Steagall Act, D. The Federal Reserve Act. Take a second. Which answer would you pick? The correct answer is C. The Glass-Steagall Act. C is correct because the Glass-Steagall Act of 1933 separated commercial banking from investment banking after regulators concluded that mixing federally insured deposits with speculative securities activity was a systemic danger. It forced the two businesses into separate corporate structures and created federal deposit insurance in the same era. It is the textbook example of regulation pulling the sectors apart. A is wrong because Dodd-Frank passed in 2010 after the global financial crisis, tightening capital rules and restricting proprietary trading. It arrived nearly 8 decades later and did not create the original separation. B is wrong because Gramm-Leach-Bliley, passed in 1999, repealed the Glass-Steagall separation instead of creating it. It moved the industry in the opposite direction. D is wrong because the Federal Reserve Act of 1913 created the U.S. Central Bank in response to the Panic of 1907. It established a monetary authority rather than separating banking activities. In the 1920s, banks took ordinary deposits and used that same money to underwrite and trade securities. When the market crashed in 1929, regulators concluded that mixing the two had turned a market collapse into a banking collapse. Glass-Steagall barred any single institution from both taking deposits and underwriting securities, forcing commercial and investment banking apart. The same era created the FDIC, ensuring deposits so an ordinary bank run wouldn't threaten the whole payment system. Once government backs deposits, the public is effectively guaranteeing that funding source. Giving that same institution the ability to take trading risk creates a broken incentive. Gains stay private, but catastrophic losses fall on the guarantor. Separation was meant to stop the guarantee from subsidizing speculation. The war stood for over 6 decades, producing 2 distinct industries with different cultures, pay structures, and regulators. That deep separation is a large part of why the 3-sector model became the standard way to describe the industry. Glass-Steagall was never a complete fix. It addressed one transmission channel, not fractional reserve fragility or bad lending decisions. Remember the direction of travel. Glass-Steagall built the wall. Gramm-Leach-Bliley tore it down, and Dodd-Frank added guardrails without rebuilding it. Question 97. Alongside the 1933 separation of commercial and investment banking, Congress created a program ensuring depositor funds up to a set limit so that an ordinary bank run would no longer threaten the whole payment system. Which underlying vulnerability was that program addressing? Your options are A. A legal requirement that banks underwrite their own securities. B. The rising cost of maintaining legacy core banking systems. C. The absence of a global standard for interbank messaging. D. The confidence dependence built into fractional reserve banking. Before I reveal it, which one do you think is right? The correct answer is D. The confidence dependence built into fractional reserve banking. D is correct because fractional reserve banking works only as long as depositors do not all demand their funds at once, which makes the whole model dependent on confidence. Insuring deposits up to a limit removes most depositors' reason to rush the doors, which diffuses an ordinary run before it can start. That is why deposit insurance and central banking developed alongside the fractional reserve model. Is wrong because no law required banks to underwrite their own securities, and the 1933 legislation restricted securities activity rather than mandating it. The concern was mixing deposits with underwriting, not compelling it. B is wrong because legacy core banking systems are a modern technology burden on incumbent institutions. They were not an issue in 1933 and have nothing to do with deposit insurance. C is wrong because a global interbank messaging standard arrived with SWIFT in 1973, 4 decades later. Deposit insurance addresses depositor confidence, not message formats. Deposit insurance doesn't just promise to repay you after a bank fails. It works by changing what you, as a depositor, have a reason to do in the first place. Under fractional reserve banking, if you suspect others will withdraw, you have a powerful reason to withdraw first, since the last person in line gets nothing. Insurance removes that reward. You get repaid whether the line is short or long, so there's no reason to join it. The guarantee mostly never has to be paid out because it makes the run irrational before it starts. The neighboring concept is lender of last resort, and the two are separated cleanly by who receives the help. Deposit insurance protects individual depositors by removing their incentive to run, while lender of last resort lends to institutions, supplying cash so withdrawal demands can be met anyway. Any guarantee weakens the guaranteed party's incentive to be careful, which is why deposit insurance arrives bundled with capital requirements, liquidity rules, examinations, and limits on permitted activities. Banks pay premiums and accept supervision as the price of access, and coverage is capped per depositor, so large depositors still have a reason to monitor their bank. This is why compliance cost isn't arbitrary bureaucracy. It's the price of the deposit guarantee and the license that comes with it. A fintech outside that perimeter dodges the cost, but it also operates without the guarantee, which matters when customers choose where to keep their savings. Question 28. A 1999 law permitted a single financial holding company to own a commercial bank, an investment bank, an insurer, and a wealth manager under one corporate roof. Which law was it, and what did it do to the earlier separation? Your options are A. The Dodd-Frank Act, which reinforced the separation. B. The Gramm-Leach-Bliley Act, which repealed the separation. C. The Glass-Steagall Act, which created the separation. D. The Bretton Woods Agreement, which had no bearing on the separation. What's your answer? Commit to one before I continue. The correct answer is B. The Gramm-Leach-Bliley Act, which repealed the separation. B is correct because Gramm-Leach-Bliley, enacted in 1999, repealed the Glass-Steagall separation and allowed financial holding companies spanning banking, securities, insurance, and wealth management. That permission is what produced the large, diversified financial institutions common today. The reflex worth holding is that Glass-Steagall built the wall and Gramm-Leach-Bliley tore it down. A is wrong because Dodd-Frank arrived in 2010 and added guardrails such as the Volcker Rule and higher capital requirements. It never reinstated the full separation and is a decade too late for this scenario. C is wrong because Glass-Steagall is the 1933 law that created the separation in the first place. Naming it here reverses the direction of the change. D is wrong because the Bretton Woods Agreement of 1944 concerned international exchange rates and created the International Monetary Fund and the World Bank. It has no connection to U.S. sector separation. Walls in financial regulation erode before they fall. By the 1990s, Glass-Steagall had already been chipped away through exemptions and clever corporate structures, and the formal repeal in 1999 simply ratified where the industry had drifted. The Gramm-Leach-Bliley Act let a single financial holding company own commercial banks, investment banks, insurers, and wealth managers together. That permission created the large diversified institutions that dominate finance today. The case for change rested on scale, competing globally against universal banks and diversification, the idea that varied revenue streams are more stable. The case against warned this would recreate the very conflict Glass-Steagall was meant to prevent, mixing insured deposits with market risk. The direction of travel is what keeps these three laws straight. Glass-Steagall built the wall in 1933. Gramm-Leach-Bliley tore it down in 1999, and Dodd-Frank in 2010 added guardrails without rebuilding it. Gramm-Leach-Bliley didn't cause the crisis, but it allowed institutions to grow large and complex enough that their distress became everyone's problem. When a stem describes sectors being allowed back together, it's pointing here. Question 29. Following the 2008 crisis, a U.S. law raised bank capital and liquidity requirements, restricted deposit-taking banks from certain speculative proprietary trading, and created new bodies for consumer protection and systemic risk oversight. Which description of that law is most accurate? Your options are A. Glass-Steagall, which fully separated commercial from investment banking once again. B. Gramm-Leach-Bliley, which permitted combined financial holding companies. C. Dodd-Frank, which added guardrails without rebuilding the full separation. D. The Federal Reserve Act, which created a lender of last resort. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Dodd-Frank, which added guardrails without rebuilding the full separation. C is correct because Dodd-Frank passed in 2010, tightened capital and liquidity rules, added the Volcker rule restricting proprietary trading by deposit-taking banks, and created new regulatory bodies. It deliberately stopped short of reinstating a full Glass-Steagall-style wall between the sectors. The clean reflex is built in 1933, torn down in 1999, guardrails added in 2010. A is wrong because Glass-Steagall is the 1933 law that built the original wall, and it was not reinstated after 2008. Assuming a full reseparation is the most common version of this trap. B is wrong because Gramm-Leach-Bliley in 1999 moved in the opposite direction by permitting combined financial holding companies. It preceded the crisis rather than responding to it. D is wrong because the Federal Reserve Act of 1913 created the U.S. central bank after the Panic of 1907. It is unrelated to post-crisis capital rules or proprietary trading limits. The most important fact about Dodd-Frank is what it did not do. After a crisis blamed on combined deposit-taking and market activity, Congress chose not to reinstate Glass-Steagall separation. Instead, it built guardrails around the combined institutions the earlier repeal had allowed. Higher capital and liquidity requirements attack the problem quantitatively, letting banks absorb bigger losses. The Volcker rule attacks it qualitatively, restricting proprietary trading at deposit-taking banks. Systemic oversight attacks coordination failure, watching risks that build across the whole system rather than bank by bank. The wall built in 1933 came down in 1999 and was never rebuilt. Dodd-Frank added guardrails to combined institutions rather than dividing them again, which is the exact assumption exam stems test when they offer full reseparation as an answer. Higher capital requirements make lending more expensive since equity costs more than deposits. New reporting and examination obligations consume staff attention. Surviving incumbents became slower and more selective, and fintech lenders expanded into exactly that gap after 2008. Regulators knowingly chose a safer, slower banking system, accepting less credit at the margin. The fintech expansion that followed was a downstream consequence of that deliberate choice, not an accident of technology alone. Question 30. A study group wants one reliable reflex for the three US. Laws that shaped how the sectors relate to one another. Which ordering is correct? Your options are: A. Glass-Steagall built the wall in 1933. Graham Leach Bliley tore it down in 1999. Dodd-Frank added guardrails in 2010. B. Graham Leach Bliley built the wall in 1933. Glass-Steagall tore it down in 1999. Dodd-Frank rebuilt it in 2010. So, Dodd-Frank built the wall in 1933. Glass-Steagall added guardrails in 1999. Graham Leach Bliley tore it down in 2010. D. Glass-Steagall tore down the wall in 1933. Dodd-Frank rebuilt it in 1999. Graham Leach Bliley added guardrails in 2010. Which would you go with? Lock it in before the reveal. The correct answer is A. Glass-Steagall built the wall in 1933. Graham Leach Bliley tore it down in 1999. Dodd-Frank added guardrails in 2010. A is correct because Glass-Steagall separated commercial from investment banking in 1933 and created federal deposit insurance. Graham Leach Bliley repealed that separation in 1999, permitting combined financial holding companies. Dodd-Frank in 2010 tightened rules through the Volcker Rule and higher capital requirements without rebuilding the wall. B is wrong because this reverses the two older laws and misstates both. Glass-Steagall is the 1933 separation and Graham Leach Bliley is the 1999 repeal. C is wrong because this assigns 1933 to a law written in 2010 and scrambles all three functions. Dodd-Frank could not have built a wall 77 years before it existed. D is wrong because this inverts what each law did while also misplacing every date. Glass-Steagall built the separation rather than dismantling it. 3 laws, 3 directions, 77 years. Glass-Steagall built a wall in 1933. Graham Leach Bliley tore it down in 1999. And Dodd-Frank added guardrails in 2010 without rebuilding it. The pattern matters more than the sequence. Restrictive regulation follows crises, when acting is politically easiest, while deregulation follows extended calm, when restrictions start to look like unnecessary drag. Each law also reveals what its era believed the core danger to be. The 1930s feared contamination of insured deposits. The 1990s feared inefficiency and international disadvantage, and the post-2008 period feared excess risk and unmanaged systemic interconnection. Even where one holding company legally owns all 3 sectors, each is still capitalized and regulated as a distinct business. The legal wall is gone, but the economic and supervisory distinction is not. This isn't a story of progress or decline. It's a system oscillating between the cost of restriction and the cost of fragility. Nothing in the history suggests the pendulum has stopped. And don't confuse the sequence with the Federal Reserve Act of 1913, which built an institution rather than drawing a boundary. Question 31. A company launches a mobile app that sends money abroad in minutes for a small fraction of a bank's wire fee, with no branches and no paper forms anywhere in the process. Which description best captures what makes this company a fintech? Your options are: A. It is regulated as a fourth sector of the financial services industry. B. It depends on a central bank facility to clear each transfer. C. It has replaced commercial banking as the primary way people hold money. D. It uses technology to deliver a financial service more cheaply, faster, and more conveniently than incumbents traditionally do. Don't overthink it. Which one feels right? The correct answer is D. It uses technology to deliver a financial service more cheaply, faster, and more conveniently than incumbents traditionally do. D is correct because Fintech is short for financial technology and covers companies and products that use new technology to deliver financial services more cheaply, faster, more conveniently, or more accessibly than incumbents traditionally manage. Lower fees, faster settlement, and no branch or paper process satisfy 3 of those 4 claims at once. The label depends on how the service is delivered, not on what kind of service it is. A is wrong because Fintech is not a sector and is not regulated as one. It cuts across commercial banking, investment banking, and wealth management rather than sitting beside them. B is wrong because access to a central bank facility does not define a fintech, and many fintechs reach settlement systems through partner banks. The defining feature is technology-driven delivery. C is wrong because commercial banking remains where most people hold their money, and a single transfer app does not change that. Fintechs pressure incumbents without displacing the sector. 2 companies can offer the exact same international money transfer, yet one takes 3 days and a branch visit while the other takes 90 seconds on a phone. The service is identical. Everything that differs is delivery, and that's exactly what the word fintech names. Fintech is short for financial technology, and it means using new technology to deliver financial services more cheaply, faster, more conveniently, or more accessibly than incumbents do. Most fintechs compete on some of these. Not all 4. A transfer app wins on cost and speed, an alternative data lender wins on accessibility, and a mobile-first bank wins on convenience. So what separates a fintech from a bank with a good app? Not the technology itself, but the cost structure underneath it. A bank app sits on legacy core systems, branch networks, and compliance built for a full-service institution, while a fintech built from scratch carries none of that weight. Fintech isn't a 4th sector beside banking, investment banking, and wealth management. It cuts across all of them. And it's easy to confuse with disruption, which describes a competitive process, not a type of company. A firm can be a fintech without being disruptive, and an entrant can disrupt without being especially technological. The real question is never whether a company uses technology, but whose revenue it's taking and from where. A software vendor selling to banks is technically a fintech, but threatens no one. That vague labeling is what produces confused strategy in boardrooms everywhere. Question 32. A course defines disruption as a process in which a smaller company with fewer resources successfully challenges established incumbents. Which sequence best describes how that process typically unfolds? Your options are: A. The entrant attacks the incumbent's largest and most profitable accounts immediately. B. The entrant first serves overlooked customers or niches with a simpler, cheaper offering, then improves until it can serve the mainstream. C. The entrant copies the incumbent's full product line and matches its pricing. D. The entrant confines itself permanently to the wealthiest customers. Got a guess? Lock it in. The correct answer is B. The entrant first serves overlooked customers or niches with a simpler, cheaper offering, then improves until it can serve the mainstream. B is correct because disruptive innovation begins where incumbents pay the least attention, among overlooked customers and small niches with something simpler, cheaper, or more convenient. As the entrant improves that offering, it moves up market and eventually competes for mainstream customers. This edge, first, then upmarket pattern explains fintech strategy choices that otherwise look self-defeating. A is wrong, because attacking the most profitable accounts first provokes an immediate defensive response from a far better resourced incumbent. Disruptors rarely start there because they cannot win that fight early. C is wrong because copying the full product line at matching prices gives customers no reason to switch and demands resources the entrant does not have. Disruption depends on being different rather than identical. D is wrong because serving only the wealthiest inverts the pattern, which starts among the underserved. Wealthy clients are usually the incumbent's best defended segment. Disruptive innovation is a process, not just an accident of technology. It describes how small entrants with few resources beat established incumbents, and the way they do it sounds backward at first. Disruptors don't start by attacking an incumbent's best customers. They target the overlooked edges, the underbanked, the small borrower, the cost-conscious saver, segments too small or unprofitable for anyone to court. This isn't weakness, it's strategy. Because these segments generate little revenue and demand different underwriting, incumbents rationally ignore them, giving the entrant years of freedom to refine its product without a well-funded rival fighting back. A model built to be profitable at the bottom doesn't stay at the bottom. As it improves, the entrant moves up market into the segments the incumbent actually cares about, arriving with a cost structure no competitor can match. The incumbent's choices were reasonable at every step, which is exactly why disruption succeeds. And remember, Fintech just names a delivery method. True disruption means taking a market position from the margins toward the mainstream. Question 33. A fintech lender launches by financing very small loans to borrowers with thin credit files, a segment large banks consider too costly to underwrite. An investor calls the strategy a mistake because the segment is unprofitable for banks. What is the investor missing? Your options are: A. Disruptors deliberately begin in segments incumbents overlook, refine the model there, and then move toward the mainstream. B. Small borrowers are inherently more profitable than large borrowers. C. A fintech must match an incumbent's full product range before it can compete at all. D. Regulators require new lenders to begin with the smallest loans available. Which one is it? Pause the video if you need more time. The correct answer is A. Disruptors deliberately begin in segments incumbents overlook, refine the model there, and then move toward the mainstream. A is correct because starting where incumbents have withdrawn gives a disruptor room to build and refine an operating model without triggering a defensive response. Once the underwriting works at low cost, the entrant can move upmarket toward the customers the incumbent actually wants to keep. What looks like a poor market choice is the standard opening move of disruption. B is wrong because small loans are usually less profitable per unit and carry proportionally higher underwriting cost, which is exactly why banks exited them. The entrant wins by driving the cost of service down, not because the segment is inherently richer. C is wrong because a disruptor's advantage comes from narrow focus rather than breadth. Matching an incumbent's full range early would erase the lean cost base that makes the model work. D is wrong because no regulation dictates the size of loans a new lender must originate first. The choice is strategic rather than mandated. Starting at the bottom of a market isn't humility or compromise. It's the only place a capital-limited entrant can actually build something durable. And there are three distinct reasons why. First, attacking an abandoned segment provokes no retaliation, since no one inside the incumbent defends revenue it never earned. Second, a constrained segment forces real cost discipline, like automation instead of manual underwriting, that a comfortable segment never would. Third, overlooked customers tolerate an imperfect product, giving the entrant room to learn under real conditions. Keep this separate from unbundling, which takes a profitable piece of an existing relationship and therefore triggers an immediate reaction. Edge-first entry attacks nothing the incumbent values, so it draws no response until it's too late to matter. The most common mistake is assuming the entrant plans to stay. Almost none do. The small segment is a base, and the entire logic depends on eventually carrying the improved model into larger, more profitable territory. On the exam, always connect the entrant's choice of unprofitable customers to freedom from retaliation and to the eventual climb-up market. Question 34. An incumbent bank's executives review a new entrant serving customers the bank turned away years ago and conclude it is irrelevant because it holds none of the bank's profitable accounts. Which risk does that conclusion overlook? Your options are: A. The entrant will be forced out of the market as soon as regulators notice it. B. The entrant's customers will eventually return to the bank without any effort. C. The entrant can perfect a low-cost model in that segment and then move up market toward the bank's profitable customers. D. The entrant cannot grow at all because it lacks its own banking license. Take a second. Which answer would you pick? The correct answer is C. The entrant can perfect a low-cost model in that segment and then move up market toward the bank's profitable customers. C is correct because the overlooked segment is precisely where a disruptor builds and proves a cheaper operating model with almost no competitive interference. Once the model works, the natural next step is up market into the accounts the bank assumes are safe. Dismissing an entrant because it currently holds nothing valuable ignores the direction it is heading. A is wrong because serving an underserved niche is not itself a regulatory violation, and fintechs have often used lightly regulated niches legitimately. Expecting regulators to remove the threat is wishful thinking. B is wrong because customers rarely return on their own to an institution that turned them away, particularly once a competitor serves them well. Assuming reversion is not a strategy. D is wrong because many fintechs scale by partnering with licensed institutions rather than obtaining a license themselves. A missing license closes some paths but does not prevent growth. Every fact in that dismissive meeting can be true, and the conclusion can still be wrong. The mistake isn't in the evidence, it's in asking the wrong question entirely. What gets asked is whether the entrant competes for anything valuable right now, and the honest answer is no. What actually matters is whether it's building capabilities to compete later, and that requires judging a trajectory, not a snapshot. Incumbents optimize for the best customers, and that's not a flaw. Money and attention flow to the highest margin accounts. So a cheap new offering always loses the internal argument. And when the entrant's product is judged, it's judged on the dimensions the incumbent's best customers care about, not the ones the entrant actually wins on, like speed or accessibility. Products get better and cost structures don't get worse. An entrant with a lean model and a growing base has every incentive to move up market, and nothing stopping it. The incumbent's profitable accounts aren't protected by any barrier the entrant won't eventually clear. Incumbents really do hold capital, brand trust, and hard-won licenses. But dismissing a small entrant turns a manageable problem into an unmanageable one by giving away the time those advantages could have bought. Question 35. A review sheet lists the conditions that gave rise to fintech disruption. Which item on that list does not belong? Your options are: A. Recurring financial crises. B. A shortage of usable data about customer behavior. C. The declining cost of technology. D. An influx of investor capital. Before I reveal it, which one do you think is right? The correct answer is B. A shortage of usable data about customer behavior. B is correct because the genuine condition is greater availability of data, not a shortage of it. Digital transactions, mobile devices, and connected sensors generate far more granular behavioral data than any earlier generation of underwriters could access, which is what made sharper decisions possible. Reversing the direction of this condition is a frequent trap. A is wrong because recurring financial crises and the 2008 crisis, above all, reordered the industry and opened space for new entrants. This is one of the 4 genuine conditions. C is wrong because falling costs for computing, storage, and bandwidth let small firms build capabilities that once demanded a bank-sized budget. This is a genuine condition. D is wrong because investors backed fintech heavily because financial services is both large and historically profitable. This is a genuine condition. Fintech didn't take off in the 1960s or the 1980s, even though computers existed and banking was profitable in both eras. 4 conditions had to align at once because any single one alone would have produced nothing. A handy memory device is 4 terms starting with the same letter: crises, compute, content, and capital. Crises means recurring financial shocks like the 2008 collapse, which reorder the industry through reform and consolidation. Compute means the falling cost of computing power and cloud infrastructure. Content means the explosion of data from digital transactions and devices. And capital means investor money flowing into a proven, profitable industry. The real insight is how these 4 interact, not the list itself. Cheap technology without capital just produces hobby projects that never scale. Capital without cheap technology produces expensive copies of existing banks. Like the dot-com era's failed attempt, and data without the other pieces produces analysis nobody can act on. Without a crisis, all 3 would still run into fast, confident incumbents defending their turf. The crisis is the trigger that makes everything else usable. It weakens incumbents and makes customers willing to switch at the exact moment cheap technology, rich data, and patient capital are ready to catch them. Keep the conditions separate from the advantages. The 4 conditions explain why fintech could emerge at all, while narrow focus, modern systems, and freedom from legacy infrastructure explain why a specific fintech beats a specific bank. Watch especially for exam stems that flip data into a shortage instead of an abundance. Question 36. A scenario notes that a wave of lending and payment startups launched between 2009 and 2013 and asks for the best explanation of that timing. Which answer captures the causal chain this course emphasizes? Your options are: A. Interest rates rose sharply, which made lending startups more profitable. B. Consumers gained access to the internet for the first time. C. Regulation of financial services was largely eliminated after the crisis. D. The crisis displaced banking talent into startups, made surviving incumbents risk-averse, and eroded customer trust in large institutions. What's your answer? Commit to one before I continue. The correct answer is D. The crisis displaced banking talent into startups, made surviving incumbents risk-averse, and eroded customer trust in large institutions. D is correct because large-scale layoffs pushed deep financial and technical expertise out of incumbent banks and into new ventures built by people who knew exactly how the old systems worked. Surviving banks turned conservative under higher capital and compliance demands, leaving service gaps that new entrants rushed to fill, especially for smaller and non-standard customers. Damaged public trust in large institutions made customers unusually willing to try an unfamiliar provider. A is wrong because rates fell and stayed historically low after the crisis rather than rising. Low rates mattered mainly by pushing investors toward higher return venture bets, which is a capital story rather than a rate story. B is wrong because consumer internet access predates the crisis by well over a decade. It was already in place and cannot explain timing specific to those years. C is wrong because regulation tightened after the crisis, most visibly through Dodd-Frank. The post-crisis environment added compliance burden rather than removing it. A wave of fintech startups launched in the years right after the 2008 financial crisis. To understand why, we need to see the crisis not as a single event, but as a condition that accelerated an industry through 3 distinct channels. First, mass layoffs released quants, credit modelers, and payment engineers who knew how lending and trading actually worked. Second, surviving banks turned risk-averse under new capital rules, abandoning marginal customers. Third, public trust in big institutions cracked, making people willing to try unfamiliar providers. Exam distractors love a single simple cause: rates rising, the internet arriving, or regulation vanishing. But a rate story alone can't explain where the founders came from. And a technology story alone can't explain why customers suddenly switched providers. This expertise did not vanish when banks cut staff. It dispersed, carried by the people themselves into a new generation of startups that could finally build financial products correctly. As an event, 2008 destroyed wealth. But as a condition, it acted as an accelerant, redistributing talent, slowing incumbents, and loosening customer loyalty all at once. Question 37. A two-person startup rents computing infrastructure by the hour instead of building a data center, and is operating within weeks rather than years. Which fintech enabling condition does this illustrate, and what is the underlying shift? Your options are: A. Recurring financial crises, which lowered the cost of hiring experienced engineers. B. Greater availability of data, which removed the need for infrastructure. C. The declining cost of technology, which converts a large upfront capital expense into an ongoing operating expense. D. An influx of investor capital, which funded construction of the data center. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. The declining cost of technology, which converts a large upfront capital expense into an ongoing operating expense. C is correct because cloud computing turns technology from a large upfront capital expense into a small recurring operating expense, which is the sharpest illustration of technology's falling cost. A capability that once required a bank-sized budget and years of build time can now be rented in minutes. Open source software compounds the effect by removing the need to write proven components from scratch. A is wrong because crises did push experienced talent into startups, but the scenario describes rented infrastructure rather than hiring. The cost shift being illustrated is technological. B is wrong because greater data availability improves decisions once systems exist to process it. It does not explain how a two-person firm obtained computing capacity at all. D is wrong because investor capital does fund startups, but this startup specifically avoided building a data center rather than paying for one. The point is that the expense never had to be incurred. Once, building financial technology meant buying servers, leasing facilities, and hiring engineers for years before serving a single customer. That capital requirement was itself the barrier to entry. Computing power has become dramatically cheaper over decades. A capability that once demanded a massive capital budget can now be rented by the hour, converting a huge upfront cost into a small ongoing expense. Capital expenditure requires committing money before knowing whether an idea works, while operating expenditure scales with usage. So a failed experiment costs almost nothing. Open source databases, encryption libraries, and frameworks compound this, letting new entrants assemble proven components instead of building everything themselves. The result is a widening gap. The cost of entering financial technology collapsed, while the cost of financial services themselves stayed sticky, propped up by branch networks, legacy systems, and compliance overhead. Fintechs are built to exploit exactly that gap. This is not the same as investor capital, which explains who funded a startup. Declining technology cost explains why that startup needed so much less funding in the first place, and why it disproportionately favored new entrants over institutions. Question 38. An online lender approves a borrower whose traditional credit file is nearly empty, basing the decision on verified employment, utility payment history, and cash flow patterns in the borrower's bank account. Which fintech advantage does this demonstrate? Your options are A. Greater data availability combined with models that use that data well. B. A larger branch network than competing lenders operate. C. Direct central bank support acting as lender of last resort. D. The fractional reserve model applied to consumer lending. Which would you go with? Lock it in before the reveal. The correct answer is A. Greater data availability combined with models that use that data well. A is correct because alternative data such as cash flow patterns and verified employment describes a borrower that a backward-looking credit score barely registers. Analyzed with better models, that data can price risk more accurately and extend credit to people the traditional system overlooked. The advantage lives in the analysis, since raw data on its own creates nothing. B is wrong because branches are an incumbent cost burden rather than a fintech advantage, and an online lender runs without them. Nothing in the credit decision depends on physical locations. C is wrong because central bank lending of last resort supports institutions when funding markets freeze. It plays no part in underwriting an individual borrower. D is wrong because fractional reserve banking describes how much of its deposits a bank lends out. It says nothing about how any single borrower's risk is assessed. A thin credit file doesn't mean a person is risky. It often just means the old measurement tool can't see them at all. Change what the lender can observe, and a whole new picture emerges. Verified employment, 2 years of cash flow, consistent utility and rent payments, and seasonal receivables. Together they describe a borrower in real detail, whether that supports approval or decline. Traditional scoring is backward-looking and demands a history of formal borrowing. That requirement systematically excludes the young, recent immigrants, people who avoid debt on principle, and small businesses funded by revenue, none of whom are inherently risky. But data alone creates nothing. A lender drowning in transaction records without the analysis to separate signal from noise is worse off than one using a simple score, because volume only mimics insight. The real advantage belongs to firms that pair rich data with strong analysis. Watch for a thin file paired with an approval based on cash flow or verified employment. That combination is the clearest signal of the data availability condition. Question 39. A course describes big data as data sets too large and complex for conventional processing tools, commonly characterized along 5 dimensions. Which list names those 5 dimensions correctly? Your options are A. Value, volume, volatility, variety, velocity. B. Volume, velocity, variety, variability, veracity. C. Volume, veracity, value, vision, velocity. D. Variety, volume, virtue, velocity, veracity. Don't overthink it, which one feels right? The correct answer is B. Volume, velocity, variety, variability, veracity. B is correct because the 5 V's are volume, velocity, variety, variability, and veracity. Volume is sheer quantity. Velocity is the speed at which data arrives. Variety is the range of formats and sources. Variability is inconsistency in meaning or flow over time. And veracity is trustworthiness. Big data matters in finance because these properties are what make sharper lending, underwriting, advice, and fraud decisions possible. A is wrong because value and volatility are not part of the standard 5. Substituting plausible sounding terms is the usual way this item is made difficult. C is wrong because value and vision are not among the 5 dimensions, and this list drops both variety and variability. Only 3 of the 5 appear. D is wrong because virtue is not a dimension of big data and variability is missing entirely. The wording is built to look familiar without being correct. Big data isn't just a lot of data. It's data that overwhelms conventional tools for capturing, storing, or analyzing it. Because the threshold moves with technology, the standard description relies on 5 properties instead of a byte count. Volume is sheer quantity. Velocity is the speed data arrives and must be processed. Variety is the range of formats, from structured records to images and sensor readings. Variability is inconsistency over time. Veracity is trustworthiness, now how much data is accurate enough to act on. Each property creates its own distinct technical demand. Volume needs distributed storage. Velocity needs real-time processing. Variety needs tools for unstructured content. Variability needs constant monitoring. And veracity needs validation before anyone acts on the data. Veracity gets the least attention but deserves the most, because a model trained on inaccurate data produces confident, well-formatted wrong answers. In lending and insurance, those wrong answers become declined applications and mispriced premiums, making veracity as much an ethical property as a technical one. Keep 2 ideas separate. Data availability explains why so much data exists and enabled fintech, while the 5 V's technically characterize what makes that data hard to work with. Question 40. A venture capital partner explains why the firm concentrated so heavily on financial services startups. Which explanation matches the reasoning this course emphasizes? Your options are: A. Financial services is a small industry with thin margins, so competition is limited. B. Regulators guarantee returns on approved fintech investments. C. Fintech startups almost never fail, which makes the portfolio math straightforward. D. Financial services is one of the largest sectors of the global economy and has been historically very profitable, so capturing even a slice can produce outsized return. Got a guess? Lock it in. The correct answer is D. Financial services is one of the largest sectors of the global economy and has been historically very profitable, so capturing even a slice can produce outsized returns. D is correct because venture investors look for markets that are both large and profitable, because a small percentage improvement in a massive, high-margin industry still returns enormous sums. Financial services passes both tests, which makes any credible plan to peel off part of that profit pool worth funding. Historically low post-crisis interest rates pushed institutional investors further toward venture and private equity, reinforcing the flow of capital. A is wrong because financial services is one of the largest and historically most profitable sectors of the economy, which is the opposite of this description. The premise is simply false. B is wrong because no regulator guarantees investment returns, and fintech carries the same risk of loss as any other venture bet. Guaranteed returns do not exist in this asset class. C is wrong because venture capital assumes most portfolio companies will underperform or fail and relies on a few very large successes to carry the fund. Fintechs fail at ordinary startup rates. Let's look at why venture capital poured into financial services, and what that reveals about how venture math actually works. Venture capital means professionally managed funds providing capital to early-stage, high-risk companies for equity. Investors are institutions and wealthy individuals, managers are professionals. And the expectation is that most investments fail while a few produce the entire return. Because a fund needs a few positions to return the whole portfolio, it must chase markets large and profitable enough that even a slice is worth real money. Financial services is among the largest sectors globally and historically very profitable, satisfying both tests better than almost any industry. 2 forces amplified this after the crisis. Years of low interest rates pushed institutions to search harder for returns, and early fintech successes proved the sector investable, attracting further capital in a self-reinforcing loop. But capital doesn't create good businesses. The same dynamic also funded companies with no path to profit, which later contractions cleared out. Capital availability is necessary but often overstated. Without it, ideas never reach scale. but capital alone can't build a viable business. Question 41. A bank executive argues that the bank can neutralize fintech competition simply by buying the same technology the entrants use. Which weakness in that argument does this course emphasize? Your options are: A. Fintechs win by pairing technology with narrow focus and a much lower cost structure, and a bank cannot easily shed legacy systems, branches, or its organizational structure. B. Fintechs rely on proprietary technology that banks are legally barred from purchasing. C. Technology is irrelevant to fintech success, which rests entirely on regulatory advantages. D. A bank that purchases new technology automatically forfeits its banking license. Which one is it? Pause the video if you need more time. The correct answer is A. Fintechs win by pairing technology with narrow focus and a much lower cost structure, and a bank cannot easily shed legacy systems, branches, or its organizational structure. A is correct because incumbents can usually acquire comparable technology eventually, which is why the technology by itself is not the durable advantage. What a bank cannot easily buy is freedom from decades-old core systems, branch real estate, large headcount, and a compartmentalized organization. The tested idea is technology plus narrow focus plus a leaner cost base working together. B is wrong because banks routinely license and purchase technology, including directly from fintechs through vendor arrangements. No legal barrier stops them. C is wrong because technology is central to how fintechs deliver faster and cheaper service, so calling it irrelevant overstates the case. The point is that technology alone is not sufficient, not that it fails to matter. D is wrong because purchasing technology has no effect on a banking license, which depends on regulatory compliance and capital adequacy. Software procurement is not a licensing event. It is tempting to say fintechs succeed because they simply have better technology, but that explanation is weak, because if technology alone were the advantage, banks could just buy it and close the gap. They've tried and the results have been modest. The stronger explanation has three parts working together: modern technology, narrow focus, and a much lower cost structure. No single element explains the result on its own. Narrow focus means one product instead of a full menu, which concentrates effort and removes coordination overhead. Modern systems matter for a specific reason. Building from scratch allows real-time automated processing from day one, while many incumbents still run on batch processing and human handoffs. That difference shows up as an approval in minutes instead of days, and that speed changes which customers can be served profitably. The cost structure is where the advantage becomes durable. A fintech has no branch network, no legacy infrastructure, and a tiny headcount, so its entire budget goes to the current product. It also shares costs by partnering with other fintechs for identity verification, compliance, and payments, and some operate where regulation is lighter, though that edge tends to fade. What an incumbent truly cannot buy is the freedom to abandon what it already has: legacy cores, branch leases, and organizational politics. Meanwhile, incumbents keep real advantages of their own in capital, trust, licenses, and customer base. The accurate picture is two different sets of strengths and burdens, not a simple technology gap. Question 42. A large bank's core ledger runs on software written decades ago. It is expensive to maintain, deeply embedded in daily operations, and cannot be taken offline for a weekend to be replaced. What does this represent and why does it matter competitively? Your options are: A. Unbundling, because the ledger has been separated from the rest of the bank's services. B. Correspondent banking, because the ledger connects the bank to other institutions. C. Legacy systems, because maintaining them consumes budget and slows change in a way a new entrant never has to fund. D. Fractional reserve banking, because the ledger is what tracks reserve levels. Take a second. Which answer would you pick? The correct answer is C. Legacy systems, because maintaining them consumes budget and slows change in a way a new entrant never has to fund. C is correct because legacy systems are older technology a company keeps running because it is deeply embedded in operations, even though it is costly to maintain and difficult to replace or integrate. A fintech built from scratch spends its whole technology budget on the current product, while the incumbent spends a large share keeping old infrastructure alive. That difference in where the money goes is structural rather than temporary. A is wrong because unbundling describes a competitor capturing one profitable slice of a bundled customer relationship. It has nothing to do with a bank's internal ledger software. B is wrong because correspondent banking is an arrangement in which one bank acts for another, where the second has no presence. The scenario concerns internal infrastructure, not interbank relationships. D is wrong because fractional reserve banking describes the share of deposits held in reserve versus lent out. What a ledger happens to record does not change the meaning of that term. Why can't a bank just replace its old technology? Because the very thing that makes it worth replacing is what makes replacing it so dangerous. Legacy systems are old hardware or software that a company keeps running because it's deeply embedded in daily operations, even though it's costly to maintain and hard to replace. The trap is hidden in that wording. The problem isn't that the technology is old, it's that it's load-bearing. Integration makes this worse. A modern product needs to connect to the core system, but that core system was often built before the internet existed. So middleware gets written to translate between old and new, and that middleware becomes one more fragile thing to maintain. This creates a spending split. Incumbents pour budget into maintaining what exists, while a startup spends everything building the current product, so equal budgets can mean wildly different progress. Compartmentalization is the related but distinct trap where business line silos, not old technology, block cooperation. A bank can't take its ledger offline for a weekend the way a startup ships an app update, because that ledger is the record of what everyone owns. The caution is appropriate, and that's exactly what makes the disadvantage so durable. Question 43. A community bank notices that its small business customers now run their card payments through a fast-growing mobile point-of-sale app. The bank still holds those businesses' checking accounts, but no longer earns the transaction fees. Which competitive dynamic does this describe? Your options are A. Fractional reserve banking, B. Unbundling, C. Underwriting, D. Correspondent banking. Before I reveal it, which one do you think is right? The correct answer is B. Unbundling. B is correct because unbundling is a strategy in which a new entrant takes a single piece of a previously bundled set of services rather than the whole relationship. Here the fintech captured the profitable payments flow and left the bank the lower margin deposit account. The bank has not lost the customer, but it has been hollowed out of its best margin business. A is wrong because fractional reserve banking describes the proportion of deposits kept in reserve against those lent out. It is an operating model rather than a competitive dynamic between firms. C is wrong because underwriting is an investment bank pricing and reselling a new securities issue while absorbing placement risk. No securities are involved in card payment processing. D is wrong because correspondent banking is a cooperative arrangement between two banks operating in different markets. This scenario describes competitive capture rather than cooperation. The bank still has the customer. That's exactly what makes unbundling so hard to spot, and why it deserves a name of its own rather than getting lumped in with general competitive worry. Unbundling happens when an entrant offers one piece of a bundled service, better or cheaper, and captures just that profitable slice without replicating the whole relationship. A small business client starts routing card payments through a mobile app, and the bank still holds the checking account. It has simply stopped earning the transaction fees. The reason this works is that bundled relationships almost never earn uniform margins across their pieces. Checking earns very little, lending offers a modest margin, and payment processing earns the comparatively rich fee that actually funds the bundle. An entrant that captures only the payments flow takes most of the profit while leaving the incumbent with most of the cost. It helps to separate this from two neighboring ideas. Customer attrition means the customer leaves entirely, taking balances with them. Fee compression means the incumbent keeps everything but must charge less. Unbundling sits between the two. The relationship survives, pricing may not even change, but one profitable component has quietly been removed. Watch for exam language about an entrant capturing one profitable service while the incumbent keeps the rest, or a bank keeping the low margin remainder. That phrase is the clearest possible marker of unbundling at work. Question 44. A robo-advisor manages diversified portfolios for a small fraction of what traditional advisors charge. Within 2 years, established wealth managers in the same market have cut their own advisory fees. Which pressure on incumbent profitability does this describe? Your options are A. Fee compression, B. Margin compression, C. Deposit attrition, D. Defensive technology spending. What's your answer? Commit to one before I continue. The correct answer is A. Fee compression. A is correct because fee compression occurs when a fintech prices a service far below incumbent norms, and incumbents must lower their own published fees to remain competitive. Robo-advisors driving down human advisor fees is the clearest and most frequently tested example of the mechanism. The incumbent may keep every client and still earn materially less from each one. B is wrong because margin compression describes an incumbent keeping a customer only by accepting a thinner spread, which shows up most often in lending and payments. This scenario specifically describes published advisory fees falling across a market. C is wrong because deposit attrition happens when customers move balances or activity to a better price provider. The scenario says fees fell, not that clients left. D is wrong because defensive technology spending is investment an incumbent makes in order to respond to disruption. It is a cost the incumbent chooses, rather than the price pressure described here. Fee compression is the most visible pressure fintech puts on incumbent profitability, and the arithmetic behind it is unforgiving. This is a market-wide mechanism, not a single relationship. A fintech prices far below the norm. Customers see the gap, and incumbents cut their own published fees to keep up, even ones who haven't lost a single client because the reference point itself has moved. Robo-advisors driving down wealth management fees is the clearest example because a portfolio managed by algorithm looks nearly identical on a statement to one managed by a human, so price becomes the easiest thing to compare. 4 related mechanisms are worth keeping distinct. Margin compression means retaining a customer only by accepting a thinner spread. Unbundling means losing one profitable component while keeping the rest. Customer and deposit attrition means the customer or balance actually leaves. Defensive technology spending means the incumbent's own investment in response, which cuts profit even when it's the right call. Fee compression specifically names published prices falling under competitive pressure. Fee compression isn't just lost revenue. It's a permanent reset of what the market believes a service is worth, which is why defending on price alone is such a weak strategy. Question 45. A bank retains a borrower who is considering an online lender, but only by matching the online lender's lower interest rate. The bank keeps the relationship and earns less on it than before. Which mechanism best describes this outcome? Your options are A. Unbundling. B. Deposit attrition. C. Defensive technology spending. D. Margin compression. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Margin compression. D is correct because margin compression is the pressure an incumbent absorbs when it holds a customer only by accepting a thinner spread than it used to earn. The bank competed on price against a leaner cost base it cannot fully match. So the relationship survives at reduced profitability. It sits alongside fee compression, unbundling, attrition, and defensive spending as a distinct mechanism rather than one vague pressure. A is wrong because unbundling would mean the fintech captured one profitable slice while the bank kept the rest of the relationship. Here the bank kept the entire loan, just at a lower rate. B is wrong because deposit attrition describes customers moving balances or activity away from the bank. The scenario states plainly that the borrower stayed. C is wrong because defensive technology spending is investment in new systems, channels, or partnerships to answer competition. No spending appears in the scenario, only a rate concession. Fintech pressure on incumbent banks isn't one problem. It's 5 distinct mechanisms, and they can hit the same institution at once. Diagnosing which one is actually happening is the essential first move, not an academic exercise. Margin compression is the trickiest to spot because the customer stays and every metric looks fine except profitability. The bank matched a leaner competitor's rate, accepting a permanently thinner spread against a cost base it cannot match. It's worth holding this distinction precisely. Fee compression is published prices falling across a market, most visibly in advisory fees, while margin compression is the spread narrowing on a specific relationship the bank chose to retain. The remaining mechanisms complete the picture. Unbundling strips out the most profitable piece while the bank keeps the rest. Attrition means balances actually leave for a wallet or higher yield app. And defensive spending is the incumbent's own costly response. These 5 can compound, each hitting a different line item, which is exactly why the total damage often goes unnoticed until it's severe. Sorting these apart comes down to 2 questions. Did the customer stay or leave? And did the whole relationship change or only part of it? Departure means attrition. Full retention at a worse price means margin or fee compression. Partial loss means unbundling. And voluntary cost means defensive spending. Question 46. A bank responds to a fast-growing payments fintech by funding an internal innovation lab to develop its own comparable app. Which strategic response is this, and what is the primary risk? Your options are A. Bar, with the primary risk being overpayment for unproven technology. B. Partner, with the primary risk being loss of control over the customer relationship. C. Compete, with the primary risk that internal culture and legacy systems blunt the effort. D. Unbundle, with the primary risk being regulatory objection. Which would you go with? Lock it in before the reveal. The correct answer is C. Compete, with the primary risk that internal culture and legacy systems blunt the effort. C is correct because building a competing capability in-house, typically through an innovation lab, is the compete response. It keeps full control and captures all the value if it succeeds. The recurring failure mode is that a process-heavy organization running on legacy systems moves too slowly for the effort to land, which is the same cultural problem that undermines many acquisitions. A is wrong because buy means acquiring the fintech outright rather than developing an alternative internally. Nothing is being purchased in this scenario. B is wrong because partner means working with the fintech as a vendor, co-brand, or minority investor. This bank is deliberately working around the fintech rather than with it. D is wrong because unbundling is a strategy entrants use to capture one slice of a bundled relationship. It is not one of the three responses available to an incumbent. When fintech disruptors first appeared, established institutions often reached for a familiar response: compete, by building an in-house alternative. On paper, this looks like the safest path. In practice, it often quietly fades. Building has real attractions. It keeps full control of the product, the customer relationship, and the data. It captures all the value without a partner's share or an acquisition premium, and it avoids the integration risk of an outright purchase. The recurring failure is cultural, not accidental. An internal lab must connect to legacy core systems, satisfy compliance built for a full-service bank, and keep pricing from undercutting existing lines. A startup carries none of these constraints, and that speed gap compounds every month. Beyond internal constraints, labs quietly starve. They compete for resources against profitable business lines and usually lose that argument. Competing works worst of all when it's a late reaction to a rival who is already scaling. On the exam, the word built signals the compete response. Remember its unique risk, unlike buying, which risks cultural integration, or partnering, which risks loss control. Competing risks being blunted by its own institution before it ever reaches the market. Question 47. A large bank acquires a fast-growing fintech at a premium. 2 years later, most of the fintech's founders have left, and the product has barely been integrated into the bank's operations. Which failure does this illustrate? Your options are: A. Regulatory rejection of the acquisition. B. Cultural integration failure between a fast-moving startup team and a process-heavy incumbent. C. Automatic loss of the bank's charter following the purchase. D. Unbundling of the fintech's product line by a rival firm. Don't overthink it. Which one feels right? The correct answer is B. Cultural integration failure between a fast-moving startup team and a process-heavy incumbent. B is correct because cultural integration is the most common reason both buy and compete responses under-deliver. A risk-tolerant startup team and a large, procedure-driven institution frequently fail to mesh, and the talent that made the acquisition valuable walks out the door. The lesson is not that acquisitions never work, but that their value depends on retaining the people and the working culture that created it. A is wrong because nothing suggests regulators blocked or unwound the deal, since the acquisition closed and 2 years elapsed. The problem emerged after closing. C is wrong because acquiring a fintech does not cost a bank its charter, which depends on regulatory compliance and capital adequacy. No automatic forfeiture exists. D is wrong because unbundling describes an entrant capturing one profitable piece of a bundled relationship. No rival takes anything in this scenario. 2 years after an acquisition closes, the founders are gone. The senior engineers have followed them out the door, and the product sits half integrated. Nothing illegal happened. The deal simply failed to deliver what was promised. Buying is one of 3 responses an incumbent has to a fintech entrant, alongside building the capability internally or partnering. Acquisition looks compelling because it delivers a working product and an experienced team immediately, faster than building from scratch. A fintech's real worth sits in the team that knows how to build and operate the product, not in the code, which ages, or the customer base, which is usually small. When that team walks, the buyer is left holding software it doesn't understand and a position it can't extend. The failure mode is cultural integration. A fast, risk-tolerant startup team collides with a slow, process-heavy incumbent. Quick decisions now need committee review. Weekly shipping meets quarterly risk assessment, and equity upside gives way to salary bands. Each response carries its own risk. Buying risks cultural failure and overpaying for unproven technology. Competing risks internal constraints blunting the effort, and partnering risks reduce control. including the fintech later becoming a rival or getting acquired. That's why partnerships risk is usually the most tolerable of the three. Question 48. A small robo-advisor has strong portfolio technology, almost no marketing budget, no banking license, and no brand recognition. It approaches a mid-sized bank, offering to power the bank's new digital investing product. Which response does the decision framework most clearly support? Your options are A. Compete by building an equivalent platform in-house from scratch. B. Ignore the fintech since it currently holds none of the bank's customers. C. Report the fintech to regulators as an unlicensed provider. D. Partner or co-brand because the fintech depends on assets the bank already holds and brings a capability the bank lacks. Got a guess? Lock it in. The correct answer is D. Partner or co-brand because the fintech depends on assets the bank already holds and brings a capability the bank lacks. D is correct because high asset dependency combined with a strong complementary fit is the clearest partnership signal the framework offers. The fintech needs the bank's customers, trust, and distribution in order to scale, while the bank lacks modern robo-advisory technology, so each side supplies exactly what the other is missing. Building from scratch would be slower and would duplicate something that already exists and works. A is wrong because building in-house takes longer and costs more than using technology that is already built and available. The framework favors competing only when overlap is direct and the fintech can scale without the bank's help. B is wrong because ignoring a complementary capability wastes a chance to add a modern product with minimal added headcount. Low current overlap argues for partnering, not for doing nothing. C is wrong because operating without a banking license is not itself unlawful for an advisory platform, and many fintechs work through licensed partners. There is no violation to report. Over time, many incumbents stopped treating fintech firms purely as threats and started treating them as partners, hiring them as vendors, co-branding products, or taking minority stakes. This shift is the most important strategic development in this material, and the logic behind it deserves a closer look. Partnership works because each side holds assets the other cannot easily acquire. A fintech brings modern technology and speed. An incumbent brings a banking license, a balance sheet, and decades of customer trust. Licenses take years, trust cannot be bought, and legacy systems cannot be modernized overnight. So trading assets makes more sense than either side trying to build what it lacks. The structural advantage of partnership is that it requires no cultural merger. The fintech keeps its own compensation, release cadence, and decision-making, while the incumbent simply gains access through a commercial arrangement, sidestepping the failure that so often undermines acquisitions and internal innovation labs. Arrangements vary in commitment. A vendor relationship is the lightest, simply buying a service. Co-branding delivers the fintech's product under the incumbent's name to its customers. Minority investment adds financial exposure and some influence without operational responsibility. But costs are real. The incumbent loses some control, becomes dependent on a third party, and the fintech could later turn into a competitor. The signal that separates partnership candidates from competitive threats is asset dependency. A fintech that needs a license, balance sheet, or customer base to scale is negotiating from a position that favors the incumbent, while one that can scale independently calls for a competitive response instead. Question 49. The board of CredSmart Bank, a $5 billion community bank, tells new Chief Executive Officer Sarah Miller to grow market share, revenue, and profits faster than peer banks while adding minimal employee and real estate expense. Toward which course of action does that constraint most directly push her? Your options are A. Technology adoption and partnerships with fintech firms. B. Opening a large number of additional branches. C. Hiring a substantially larger in-person sales force. D. Exiting the commercial lending business entirely. Which one is it? Pause the video if you need more time. The correct answer is A. Technology adoption and partnerships with fintech firms. A is correct because the limit on employee and real estate expense rules out the two most obvious growth levers, which are more branches and more staff. What remains is growth through technology and through outside partnerships that add capability without adding headcount or square footage. That constraint is the reason the mandate is framed as a sorting problem between competitors and partners, rather than a spending problem. B is wrong because new branches are the clearest form of added real estate expense, which the board explicitly limited. The constraint eliminates this path directly. C is wrong because a larger sales force is added employee expense. The other costs the board ruled out. Growing headcount contradicts the mandate on its face. D is wrong because nothing in the mandate suggests abandoning a core business, and exiting lending would shrink revenue rather than grow it faster than peers. The board asked for growth, not retreat. Every clause in Sarah Miller's mandate as CEO of CredSmart Bank is doing real work, and reading each one carefully is what makes this exercise solvable. The first clause rules out defending the status quo, demanding an outside assessment of fintechs. The second rules out adequacy, since matching peer growth isn't enough. The third and most decisive is the expense limit that students tend to skim. Minimal added expense eliminates the two conventional growth levers. Opening branches adds real estate, and hiring lenders or advisors adds headcount. With both removed, growth must come from technology and outside partnerships instead. Scale matters too. A $5 billion bank is substantial locally but small nationally. CredSmart cannot outspend big banks on technology or match their product breadth, but it can move faster locally and reach modern capability through partnership instead of expensive internal construction. Together, these constraints push toward a partner-first posture, rent, co-brand, or refer fintech capabilities, and reserve building only for rare overlaps with the bank's core. The expense limit is the most tested detail because it's exactly what eliminates the tempting but wrong answers about branches and hiring. Question 50. A bank executive panics over a new identity verification fintech, calling it a threat to the bank's customers. On inspection, the fintech's entire business consists of selling verification services to banks and their partners. Which framework question resolves the misread most quickly, and what is the correct classification? Your options are A. Capital position, which shows the fintech is well-funded and therefore a competitor. B. Build versus time, which shows the bank should build its own verification tool immediately. C. Target overlap, which shows the fintech sells to banks rather than to the bank's depositors, making it a vendor and partner. D. Complementary value, which shows the two firms are fighting over the same fixed pool of margin. Take a second. Which answer would you pick? The correct answer is C. Target overlap, which shows the fintech sells to banks rather than to the bank's depositors, making it a vendor and partner. C is correct because asking who the fintech actually sells to is the target overlap question, and it diffuses the panic immediately. A firm whose customers are banks has no overlap with this bank's depositors, and in fact depends on institutions like this one for its own revenue. No overlap plus high asset dependency marks a vendor and partner rather than a competitor. A is wrong because capital position matters most once a fintech has been shown to compete head-on for the same customers. It is the wrong first question when the two firms are not chasing the same buyers at all. B is wrong because bill versus time is worth asking only after overlap establishes that a competitive response is warranted. Building an in-house verification tool would duplicate a service the bank can simply buy. D is wrong because complementary value points toward partnership when each side brings something the other lacks, which is the situation here. Describing it as a fight over a fixed pool of margin reverses the correct reading. Deciding whether a fintech is a threat or an ally isn't intuition, and it isn't a default assumption in either direction. A manager's framework asks a small set of diagnostic questions, and asking all of them is what prevents both panic and complacency. Target overlap comes first. Does the fintech chase the same customers head-on or serve a different market entirely? Like a verification firm that only sells to other banks? Asset dependency comes second, the strongest partnership signal. Asking whether the fintech needs your license, balance sheet, or customer base to scale. 3 more questions refine the picture: build versus time, capital position, and complementary value. 2 classic examples make the logic concrete. The identity verification firm sells only to banks, so there's no customer overlap and no reason for alarm. The Robo advisor has great technology, but needs the bank's license, balance sheet, and distribution to scale, which makes it dependent, not dangerous. The same 5 questions produce different answers for different firms. A well-funded payments app targeting the bank's small business customers is a competitor. A capital-constrained robo-advisor seeking distribution is a partner, and a microloan platform serving abandoned borrowers is pure referral income. Treating every fintech as a competitor wastes resources fighting firms that would rather partner, while treating every fintech as a partner leaves the profitable core undefended against real threats. The right posture comes only from working through the signals. That finishes our exam prep review of Domain 1, the financial services landscape and fintech disruption. If you'd like to keep practicing these topics, come visit our website. You'll find hundreds of completely free practice questions along with full, detailed study guides covering everything you need already and waiting for you to dive right into. Just check out the link down in the description below and you can get started practicing right away. Subscribe to follow along with our next video, and good luck on your Innovation in Finance exam.